In this presentation, we will be discussing the Child Tax Credit, CTC, and Additional Child Tax Credit, ACTC. If you would like to jump to relevant topics within the presentation, you can go down to the description below and we'll break out the presentation to relevant topics within it, provide links to those topics so you can jump directly to them from there. As we go through this, we're going to be discussing items from Publication 972 and from instructions for the 1040 and other resources, many of which you can find on the IRS website at irs.gov, irs.gov. We'll discuss what the child tax credit is, qualifications for the child tax credit, thought process in worksheets to see if we qualify for the child tax credit, resources from the IRS on those qualifications, the difference between the child tax credit and the additional child tax credit, the CTC and the ACTC, and when the additional child tax credit will apply. We'll run scenarios within tax software so we can actually see the line items in the tax forms of the child tax credit and the line items for the additional child tax credit. We'll also run scenarios for situations where we have two individuals that might be single and then get married, or married and then get divorced, and think about what it would look like in terms of different scenarios for the child tax credit related to those situations, going from one tax return to multiple tax returns back to one tax return. Those are just a few of the topics that we'll take a look at. Again, you can go down to the description below and see if any of the relevant topics there are relevant to your needs and jump straight to them. In this presentation, we will be discussing what is new with the child tax credit. This information will be coming from Publication 972, which you can find in your resources. You may be asking why we're going over new information for the new changes to the child tax credit if we don't have an idea of what the current child tax credit is. And the reason we're going to do that is because oftentimes people have some idea, even if they haven't used the child tax credit in the past, of what it is. And it's important to note what is changed because it's difficult to unlearn things. Once we have something in our mind, it's difficult to unlearn it. So we want to make sure to start off with that information so that we can know that we need to unlearn this information, or if what we're saying here contradicts what's in your mind, of course, that's because there's been changes to the tax law. So if you're completely new to the child tax credit, we will go through the current law in future presentations, but we want to go over those things that have changed first. It's also important to talk with other people about the changes to the law because you'll note that things are difficult to unlearn. And if you talk to just normal people about things like tax law, they might have tax laws that are like 30 years old in their mind and they've just never replaced them. They've just been there for so long that even though the law changes, it's very difficult unless we consciously go in and kind of reset our mind. Then it's difficult to change those thoughts in our head. So many people have old laws and we need to communicate with other people about the changes in the law and kind of have an idea of why they might have a different thing in their mind about what the current law is. And we can then go from there as we discuss the changes. First, we have the new Social Security number requirement for a qualifying child. So the qualifying child is going to be one of the requirements for the child tax credit. Of course, we need to have the qualifying child. To claim the child for tax credit, notice the child tax credit will be abbreviated oftentimes with a CTC. So whenever you see CTC, child tax credit, or additional child tax credit, ACTC, we'll see these terms as we go, and we will go into more depth with them. Your qualified child must have the required Social Security number, SSN, Social Security number. If you have a qualifying child who it was not issued an SSN, Social Security number, valid for employment before the due date of your 2018 return, including the extensions, you cannot use the child to claim the child tax credit or the additional child tax credit on either your original or amended 2018 return. So that's the first change we have there. If your qualifying child does not have the required Social Security number but has another type of identification number issued on or before the due date of your 2018 return, including extensions, you may be able to claim the new credit for other dependents for that child. So in other words, if you have some other kind of qualification, then, and note that the due date is including the extension here, you may be able to claim the new credit for the dependent for that child. So the new credit being the dependent credits. So we'll go through the worksheets of what the child tax credit and what the dependent credit are. And then increased child tax credit, the maximum amount of the child tax credit has increased to $2,000 per child. This is probably the most significant change that most people are thinking about. There's a big increase in the amount of the child tax credit, which is now $2,000. That's a dollar for dollar tax back. A credit then is going to be worth much more than the same amount of a deduction because it's going to give you that dollar for dollar tax back. So if we had basically a tax liability of $10,000 and we got a credit, then we would reduce it all the way down to the $8,000. As opposed to if it was a deduction, it would be a lot less of a decrease on the tax liability, and it would be dependent on our tax brackets. There's also an increase in the phase out for the child tax credit. So basically a phase out means that as income goes up, we get less and less of the child tax credit. So obviously from our perspective, we would like a high phase out because then we don't have to worry about losing the child tax credit because it'll be phased out as income increases. Back to the text. When figuring your child tax credit and credit for other dependents, the threshold amount for the limitation based on adjusted gross income has increased to $400,000 in the case of a joint return and $200,000 for all other returns. So that's pretty high. So if we're a joint, in other words, if we're having a married return, basically the income of our return has to be $400,000 before we start losing the child tax credit. That's pretty significant. And therefore, we're likely to get the child tax credit. $200,000 for all other return types, meaning obviously you have married, filing, joint, and then the other types of return, single, head of household would be the other two most common. And so we have the same basically cap there. So if you're single, head of household, and you're making under the $200,000, then you shouldn't have to worry about the phase out of the child tax credits. There's also an increase of the additional child tax credit, and that's going to be to $1,400. So this concept is a bit more confusing, but it's something that applies to a lot of taxpayers. In other words, if we have income that results in us not owing any taxes, our income is low enough that we don't owe taxes, then we still may get a refund for the child tax credit up to the $1,400, even though we don't owe any money. In other words, we could get money back, and that means that we're not really having a tax in that case. If we don't owe any taxes and we get money back, it's not a refund in that case. It's basically some kind of benefit that we are getting. And so therefore, the child tax credit is a credit that can result in a refund or some type of money back, even though we have no tax liability. And that's going to be in part due to this increase in additional child tax credit. So the maximum amount of the additional child tax credit has increased to $1,400 per qualifying child. So that's going to be per each child. We could get the $1,400. Notice, of course, again, that's less than the $2,000. So if we had a tax liability of say like $10,000 and we had the child tax credit, or if we had two child tax credits, right, we would get $2,000 per child. However, if our tax liability then goes down to zero, then you might say, well, now I don't get any benefit because, of course, we don't owe any taxes. And you can't have taxes go negative because that's not a tax anymore. Well, now you can have taxes go negative, which means, yes, it's not a tax anymore, but it's a type of refund that is still going to be processed due to a credit such as the child tax credit. There's also a decrease to the earned income threshold. So the earned income threshold represents the amount of earnings that have to be there to take the child tax credit. And the idea about this is basically the idea that the government's trying to give benefits to people based on the child tax credit. However, they also want to incentivize work. And those two things have opposite kind of incentives oftentimes. So therefore, they're going to say that there's got to be some type of earned income throughout the year in order to qualify for the child tax credit. So, you know, if you're on the threshold, then of course you want the earned income threshold to be lower just to make sure that you're earning the income. So remember, we're kind of in a range here. If we're single or head of household and our income goes too high, above $200,000, we could lose the child tax credit. If our income is low to the point that we have no tax liability, we could lose part of the child tax credit due to the fact that we're going to be below the threshold. And then if we don't have any income related to the earned income threshold at all, then of course, we could lose the child tax credit as well. So these two things are kind of in the same basic area. meaning this 1,400 is something that we could get from a child tax credit even if we have low income. But if our income is very low, which is decreased below the earned income threshold, then we may lose even this amount of the lowered amount because we have no tax liability because the government wants to incentivize basically work. So back to the text, and this 2,500 is the lower amount, and that means that if you go below the 2,500, we'll basically lose all of this $1,400 credit, and it'll phase out until that point. So if you get down to the 2,500, then you've basically completely lost the child tax credit and the additional child tax credit, and then it'll go up with earned income up to a maximum of 1,400, even if we have no tax liability. And then as we increase the tax liability, then of course we're back into the child tax credit, which could increase as we have a tax liability. The credit then will increase to the max of the 2,000. The earned income threshold for claiming the additional child tax credit has decreased from 3,000 to 2,500. So we'll see some examples of this as we go through the law. But note what that means is if you have less than 2,500 of earned income, you're not even going to be able to qualify for the 1,400. You're not going to owe any taxes most likely because of course the income is below the point at which you'll be owing taxes. However, you're not, if you had more than the 2,500, you may still get a refund even though we don't have taxes due to the fact that we have this additional child tax credit amount. There's also going to be a new credit for other dependents. And this is kind of the result of the fact that there's no exemption for just a normal dependent. So you might say once they got rid of the exemption, then the benefit of having dependents other than the child tax went away. So now they're going to say, okay, we'll give some kind of benefit, a credit, for dependents that aren't related to the child tax credit. And so that's why these things kind of go together. So when you think about a dependent, your first thing is, well, does it qualify for the child tax credit? Because that's going to be huge. Compared to anything else related to, and then if not, then you say, okay, well, can I still get now the new dependent credit? So these two things are kind of linked together in that way. We're concentrating here on the child tax credit, but just realize that as you go through your series of questions, if the child tax credit does not apply, then of course your next step is to say, okay, what about the dependent credit? Do we still qualify for the dependent credit? So back to the text. If you have a dependent, you may be able to claim the credit for other dependents. This is the other dependent credit, ODC credit. The ODC, other dependent credit, is a non-refundable credit up to 500 for each eligible dependent who cannot be claimed for the child tax credit. So now what happens there is you're saying, okay, we have a dependent, and so we'll discuss the rules for dependents and whatnot later, but we have a dependent here, doesn't qualify for the child tax credit. We may still get the 500 credit then if we have the qualification for the other dependent credit. Child tax credit, amount of credit. Now that we've discussed the new items for the child tax credit, we're going to go back in and build up and discuss what the child tax credit is in some detail. We're going to start off with the most important point to most people is how much is the child tax credit. So we'll start off with the basics of the amounts of the child tax credits and some basic limitations, and then we'll move forward from there in future presentations. This information is coming from publication 972 for 2019, which will be provided in your resources. Back to the text. The maximum amount you can claim for the credit is $2,000 for each child who qualifies you for the child tax credit. So the CTC will be the child tax credit, but there will be limitations that we'll talk about later. So that's going to be a huge amount. This can be a huge credit for many people. So we have $2,000, and then we got to, of course, determine what is a qualifying child. We'll discuss that later. But the qualifying child, you get $2,000 per qualifying child. We'll discuss what the limitations are later. There's going to be various types of limitations, but note that's going to be a big credit. What a credit means is it will be a dollar for dollar reduction of the tax liability. So I'm trying to say reduction rather than a deduction because it's different from a deduction. So you want to keep that in mind. The deductions are going to be the calculation of the taxable income. A credit is on the bottom. It's kind of equivalent to a payment. So the credit, if you have a dollar for dollar credit versus a dollar for dollar deduction or the dollar amount of $2,000 in this case of a credit versus a dollar amount of $2,000 of a deduction, the credit will be far more valuable, a $2,000 credit, far more valuable than the same amount $2,000 deduction. So just keep that in mind. We'll now discuss some of the major restrictions. We're going to read through the text and then we'll explain the text. So the maximum credit amount of the CTC, or the child tax credit, or ODC, other dependent credit, may be reduced if either one or two apply. So let's discuss these one or two. One condition, these are going to be the reductions to the amount of the credit that might happen, the $2,000 credit. What would be the reduction to it? Back to the text. 1. The amount on Form 1040, line 11, or Form 1040 NR, line 45, is less than the total of both credits. If this amount is 0, you cannot take either credit because there is no tax to reduce. So let me just stop there and break that out. What are we talking about? Well, we'll take a look at the line items when we get to the tax return, and we'll be able to see this physically and it'll make sense. But it's basically saying, hey, you can't take a credit if you don't owe any taxes. That's going to be the first thing. That kind of logically makes sense, because if a tax means that we're paying something. And so what this is saying is, look, the credit's going to be reduced from 2,000 to something below that. It could potentially go down to 0 if there's no tax that is due. That's in essence what's happening here. They're saying that, you're not going to get a benefit of a credit if there's no tax. Now, of course, don't stop there. We're not quite done yet, so let's keep going. That could be bad for some people. We'll keep going here. But you may be able to take the ACTC, which is the additional child tax credit, if you are claiming the CTC child tax credit. You cannot take the ACTC additional child tax credit if you are only claiming the ODC other dependent credit. What does that mean? So it's in essence basically the same. Most people will probably think of the ACTC as basically the same thing, the additional child tax credit, as the same thing as basically the child tax credit. But from the code, it's the law is basically breaking it out into two separate things, so we can say two separate things. Mainly, the child tax credit is a credit that doesn't go below 0 on the liability. You can't use the child tax credit to take you below the 0 threshold amount. But we have the additional child tax credit, which is kind of the same thing, which means that, in other words, a child tax credit is kind of like a credit, whereas the ACTC, the additional child tax credit, is more of like a welfare type program or a benefits type program, because this, of course, is giving a benefit above and beyond the tax. So that's basically, from a practical standpoint, that's what you can think of these two things as kind of the same thing. But the child tax credit is $2,000, and if you owe no tax, then you may not get the whole $2,000 back, because of course there's no tax owed. However, you may still get some money back, because there's going to be some amount that you may possibly still get, even if you don't owe any money. And we're just going to name that basically additional child tax credit, which basically means the amount that's going to possibly be received over that. For practical purposes, what that means is the $2,000 might be reduced if we don't have any tax liability. And so then we're going to, of course, want to know, well, what might it be reduced to if we don't have any tax liability? And for that, we need to think about, for tax code laws, the additional child tax credit. And we'll do that in following presentations. So the other thing that might reduce that $2,000 is this item number 2. Back to the text, number 2. Your modified adjusted gross income, or AGI, adjusted gross income, is more than the amount shown below for your filing status. Married filing joint, $400,000. All other filing status, $200,000. So this is a pretty big threshold. I mean, this basically means that you're going to get a $2,000 credit, but if you're married and you have like income, adjusted gross income, you're basically the money you're receiving in general for income, gross income before many of the deductions, is $400,000, which is pretty high, then you're going to lose it. So if you're up around that threshold, that you may lose the credit. If all other tax filing, that would be single or head of household, or the two other most common kind of tax filings, it's $200,000. So you may get the other, you still get it if you're single, if you're not married, in other words, up to the $200,000 limit. And of course, twice the limit is there for married, because the idea is that many households these days are 2-income households, and therefore the threshold is twice as much for the married individuals. So this is generally pretty good for most people because most people don't have to worry about the upper threshold. Probably, I mean, if they are worried about the upper threshold, the 2,000 credit is not something that they are completely dependent on. So the upper threshold probably isn't, may not be as much a concern for one reason or the other, and less of a concern for people that are really, looking for that $2,000. And then the lower threshold, which is going to be this item, is probably one that many people are concerned and looking through on as to whether they're going to have a reduction of the child tax credit. Now you might have a question. We'll get into some technicalness of what is adjusted gross income and what does it mean to modify it. So we're talking, I mean, basically you can think of it as just basically kind of generally gross income, but adjusted gross income is really kind of our gross income, taxable income, minus basically the above the line type of deductions. And even then there's going to be some modification for it. So, I mean, from a general standpoint, basically if you're making over the 400,000 and you're kind of close, then you can, obviously we're just thinking in general terms, basically what your gross income is. But technically the adjusted gross income of course is a line item on the tax return, gross income, taxable income, minus above the line type deductions. And not only that, but now it's modified. So now it's a modified adjusted gross income. So what does that mean? We'll go into some detail of this. It's probably going into the weeds for most people, more in depth than you need, but we'll just get some idea of that. So what does it mean to be modified AGI? Adjusted gross income's on the tax return. Remember, we know what that is. That's on the tax return. We can say, okay, and we'll look at a tax return and we'll see, hey, there's AGI, adjusted gross income. But what does it mean to have it modified? That's not on the tax return, at least not directly typically. But that's what we need technically to get the child tax credit. So in other words, there might be some changes to the AGI. Back to the text. For purposes of the child tax credit and other dependent credit, your modified AGI adjusted gross income is your AGI adjusted gross income plus the following amounts that may apply to you. So we're going to take your AGI and we're going to increase it by these amounts as it applies to this particular thing we're trying to calculate, which is the child tax credit. Back to the text. And of course, software is very useful to figure out what these modifications will be, as we know the kind of like the general rules, and then kind of hopefully help software to help us out with these kind of funny modifications that are going to add some detail to those general rules. So first one that we're going to add to the AGI, back to the text. Any amount excluded from income because of the exclusion of income from Puerto Rico. On the dotted line next to Form 1040, line 7, enter the amount excluded and identify it as EPRI. Also attach a copy of the form. So if that applies, Puerto Rico, to us, then that's going to be one thing that could apply to the modified AGI. Next item, we're going to add back to the AGI for the calculation for our modified AGI related to child tax credit. Any amount on line 45 or line 50 of Form 2555 for foreign earned income. So if we have some foreign earned income, then that could be a factor that we have to factor into the calculation of our modified adjusted gross income for the child tax credit. Next item that we might have to add back is, back to the text, any amount on line 15 of Form 4563, exclusion of income for bona fide residents of American Samoa. So again, if that applies to us, that might be something that we have to apply there. If not, of course, it's not something that we have to modify our adjusted gross income for. If you do not have any of the above, your modified AGI is the same as your AGI. So technically then, again, these will be specific cases, and therefore you're going to take your AGIs, basically the income limitation we talked about with those caps, and if you don't have any of these items that would adjust it, then your AGI is something that we can directly find on the tax return. And right here it says AGI, back to the text. Your AGI is the amount on Form 1040 line 7 or Form 1040 NR line 35. So we'll actually see an example of the tax return shortly, and we'll take a look at where we can find that adjusted gross income or AGI amount. In this presentation, we will use tax software to take a look at the child tax credit. We're going to use the most kind of straightforward type of example to see how the child tax credit is looking on the tax form, the calculations for the child tax credit with the use of the tax software. Here is our test 1040. This is going to be a mock 1040. We currently have a single individual. It's going to be Adam Smith. This is going to be a mock name, mock social security number here. We have the mock address. And then, of course, we're going to say that it is going to be a dependent. We have a dependent, in other words, which we're just labeling dependent 1, last name Smith. And that's going to be the son, and that's going to give us the child tax credit qualification. We'll talk more about this component, what is a qualifying child, and how to enter that information, or what would qualify as a qualifying child for the child tax credit. But for now, we want to think about that kind of basic calculation from the line items on a tax return. And of course, to do that, we need the qualifying child. That's going to be the end of page 1, and then page 2, although we're scrolling down on the same page, this is technically page 2 now. So we're now on page 2. We're going to say that our first scenario is 50,000 of wages. We're just going to say it's W-2 wages from a single individual, 50,000 of wages. That's going to be on line 1. And then you'll notice line 6 here has the total income, and then line 7, the adjusted gross income. So the adjusted gross income is that one that we're kind of familiar with. When you look at the child tax credit, they say, well, there's the upper threshold of 200,000 and the lower threshold and whatnot of the AGI. So note in this case, as in many cases, the AGI, line 7, adjusted gross income, is the same as line 1, because the adjustments between the two are usually those above the line deductions, which are the less kind of common deductions. Most of the times when we think about deductions, we think about like the itemized deductions. The above the line deductions, some of the most common are self-employment, half of the self-employment tax if we have like a Schedule C business, or an IRA if we have an individual retirement plan, as opposed to like a 401k plan or something like that. Those would be the, so note that, in other words, when we see that limitation, which oftentimes in many tax code laws, it says something like adjusted gross income or modified adjusted gross income, then that's kind of similar to the income level, including those above the line deductions that you need to kind of think about what the above the line deductions are. So when you think about it from a broad sense on these income limitations, you're thinking about it, okay, that's kind of like if my gross income goes over this amount. It's not including the many deductions that many people take in terms of the itemized deductions if you itemize, and it doesn't include the standard deduction, which everybody gets, which in this case is 12,000. So if you had some other kind of funny things that applied as well for the modified adjusted gross income, then we would have to take this number, line 7, and adjust it for any modifications. But again, from a general rule standpoint, basically if the income goes up, we're talking about kind of the gross income, the AGI, as opposed to more of the net income, which would be net of things like the standard or itemized deductions. So that's kind of like the general rule when you're thinking of your threshold as to whether or not you make enough or over the threshold or under the threshold with regards to many types of tax laws. So then we have the standard deduction, and that's going to give us our taxable income, the 50,000 minus the standard deduction. Very straightforward. Then we're going to have the tax calculation. And how did that happen? Well, the tax software just magically helped us to make that, because of course it is on a progressive tax system. It's difficult to calculate that. It's pretty clear that if we add this up, we could figure this number out. I can write that out on a piece of paper, put it in Excel, and say, I can see where that. But this, of course, we'd have to go to tables and figure out the tables of the progressive tax system. And that's why we basically depend on software most of the time. So we can verify this number very clearly. This number we're kind of more dependent on the software to do. And then, of course, the thing we're concerned with is this 2,000. So there's the 2,000 credit that we have in this basically scenario. We have no problem with the fact that we still have a liability. So note that this liability doesn't have anything to do with the payments that we've made. We might have made withholdings. Like in this point in time, we have the total tax after the credit to 2,000. So this is our tax before. Credit brings it down to 2,273. We don't have any withholdings right now, and that means that we owe that 2,347, and we have this increase in the penalty that's being calculated here. Note that this has to do with the tax liability, not the withholdings. So in other words, what if we withheld on the money? So what if we earned 50,000 and we enter the withholdings now? So let's do that. So if I go to my data input. Now I said that we withheld 10,000. So now I'm going to say that we withheld on our W. So we made 50,000. We withheld 10,000. That's a payment. So you'll note that this number didn't change. The 4,373 liability is the same. The 2,000 is still there. We still have the 2,000 going down to take the liability to 2,273, and we paid 10,000, and therefore we're getting a refund of 7,727. So in other words, when you think about the fact that there's a lower limit kind of threshold that we can't go below zero, it doesn't mean that we can't have a refund, that the 2,000 is not going to give us the refund. What it means is that the 2,000, you're going to have some problems or some issues we'll talk about in the next presentation when this liability amount has nothing to do with your withholdings or payments. When this liability amount gets close to below 2,000, then that's the point at which we're possibly not paying any taxes. Because if this amount goes down below 2,000 and then we have the credits, this credit's going to bring it to zero. And then we might get the additional child tax credit that could give us some more benefit below that. So just realize that when you're considering whether or not you're going to get the credit because of the amount of liability, we're talking about liability, not the amount of refund. The amount that you paid right here, in this case 10,000, has nothing to do with basically the liability. It just means that we paid it already. We paid the liability already, and therefore this is a refund, as opposed to basically kind of a welfare or like kind of some kind of social program that's giving us money above and beyond what we paid. Just because we got 7,724 back in this case doesn't mean we didn't pay any taxes. We did pay taxes. We paid 2,273. We just happened to overpay we paid 10,000 and got it back. On the other hand, if this number goes below the 2,000 amount, then it's possible that we get money back even though we didn't pay anything. Meaning, if we withheld 10,000, we'd get the whole 10,000 back and maybe more based on that. And that would mean that we didn't pay at all and in essence possibly got more money, got money back, which means it's not a tax. So we'll talk about some kind of thresholds and some scenarios like that next time. This is kind of the most straightforward kind of method where we have just that 2,000. And then here's just the same example, but now we're going to say it's married filing joint. So if we have Adam and Mary Smith, we still have the single individual here. Now it's just a married filing joint return, and we're going to say we doubled the income to 100,000. 100,000, we're going to say they both earn 50, and we'll talk about variances and earning levels and all that kind of stuff later. But now we got the 100. So now the standard deduction is 24,000. It's a lot higher. So if we still have that 50,000 income or a lower income, it might take us to the point, of course, where we wouldn't have the tax liability. But now we're saying 100,000. That gives us the taxable income of 76, and then we let the system calculate the tax at 8,742 now, because it's a married filing joint and we have 100,000. Well, the tax credit is still 2,000 because we still have that one child, and that one child tax credit, maximum tax credit, is the 2,000 here, bringing the liability down to 6,742. That's the liability. If we say that we still withheld from our paycheck 10,000, then we're going to get money back. We have the refund, in this case, 3,258. So again, even if we didn't pay any money, if we go back to the data input and say we didn't have any withholding, then what would happen? Well, now we still have the 8,742 minus the child tax credit, bringing it down to 6,742. And we owe now that 6,740. We didn't withhold any money. We'd have to write a check and probably a penalty because, of course, we didn't pay on time. And just to clarify that, we could have filed on time still, but the IRS wants to be paid throughout the year, not at the end of the year. So that's why we have the withholdings. So there is some confusing when you consider this credit between what does it mean to have a tax liability versus the amount owed or refund. And the amount of the credit will depend in some part on the liability, not so much the payments that we make. In this presentation, we will use tax software to take a look at some of the limitations with the child tax credit. In other words, we'll put in some different scenarios into the tax software which have to do with some of the limitations for the child tax credit, and use the software to help us think about those types of limitations, help us to tinker around with different scenarios and look at the tax forms as we do so, and the effect of on the tax forms from our data input and what the software does with it. Here is our simple sample, test 1040, with our single individual with the mock information of Adam Smith, mock social security number and address. And of course, we have the one dependent here for our child tax credit calculation. First name, dependent 1, last name, Smith. And the dependent does qualify for the tax credit. So then we're going to scroll down to page 2. So we have page 2. We won't go into a lot of depth because we talked about this in a prior presentation. This is going to be our basic scenario where we get the full credits. So we have the $50,000 of the single individual income, the taxable income $50,000, the adjusted gross income of that $50,000. We have no above the line deductions. This is what the threshold is that we typically will think of. It's a modified AGI, but in essence, the AGI for like things like income limitations that might phase out. Then we have the standard deduction of the $12,000, bringing the taxable income to the $38,000, tax then being calculated by the system, $4,373. And then we have the $2,000, which is safely within that range. And therefore, so we're going to take that $2,000 and reduce the taxable amount by it, bringing the tax down to $2,373. Note last time we had another 100 from another credit with what was added on Schedule 3. So now we just have the 2,000 here. So 2,373, and that gives us the amount owed if we don't have any payments. That's our base amount. Now let's say that the income goes up. The upper threshold is 200,000. So let's say we had basically 200,000 of income. If we go back and we say, all right, now we're going to say the wages are going to be 200,000. What does that do? If we go back to our forms, we're going to see it's still 2,000 on the credit. So of course our income changed. Our tax amount is the 48,850. That's the amount of the taxable income being that 188. Well, that's because it's the lower limit, right? And so once we go up from there, if we have the 201,000, and if we go back over, then we're going to say, okay, so now it's changed due to our worksheet. That's a phase out. So it's phasing out. We're not going to get into the full, what's the calculation as the phase out goes. We're just going to say, okay, the phase out starts at the lower limit for the single individual at the 200,000, and then we start to phase out from that time. You can go through this calculation on the worksheet to see basically what the phase out calculation will be. Of course, most people don't memorize the phase out calculation, but it might be something you're interested in. Once you start to get over a certain threshold, the 200,000, then you start to phase out the child tax credit. So here's the information on the worksheet for that. If we were to continue to increase the amount, let's just say now it's 201, 202. If we go back over, you can see the child tax credit 1950 is going to go down to 1900. If we take it up to 210,000, and if we go back over, we're going to say, all right, what happens there? 1,900 is going to go down to 1,500. If we take it to 15, we're going to say, let's go back over 1,500, 1,250. If we take it to, let's say, 25, 225, we've got 1,250 down to 75. If we take it to 30, so you can see the phase out going relatively slow here as we keep on increasing the income. So now we're down to 500. If we take it to 40, so 240,000, we have the 500 going to 0. So no, now we're basically phased out and we're not getting any of the child tax credit. So we'll have a similar thing if we get over the 400,000 for married filing joint. So if we had the married filing joint, we'd see a similar phase out. But you might also think now, well, what if I had two dependents? So now we've got two dependents, and we're going to say, okay, what happens now? We got the single individual two dependents, and we're going to scroll down and say, oh, now we have 2,000, right? Rather than 4,000. So let's break that out again. If I go back over and we'll say, okay, what if we got our second dependent? What if we only made 100,000 and we had two dependents? So now we've got 100,000. We would get, of course, 4,000. 2,000 times two qualified dependents. And so that would give us the 4,000. And then if we hit the 2,000, the 240,000 amount of income to the phase out, then it's going to phase out, but now it's down to 2,000. And again, you can see the calculation, the way the calculation works on how that is going to be calculated. We're just going to go run some tests now. Now it's at 2,000. So let's keep on. So it's been phased out because, of course, we're over the threshold. The phasing out starts at the 200,000, but now we have the second child. So what if we keep on increasing and saying we got 260,000, and if we go back over and say, all right, 260,000, now we're down to 1,000. And so you can see the phase out, basically how the phase out is kind of working, 280,000. If we bring the income to 280 with our two dependents now, we can see that we're back down to 0 on the credit. And so now we have two dependent. Well, what if we added a couple more dependents? We said, oh, well, what if we had two other children just to see what this would look like in terms of the tax software? We're going to say, all right, we got dependent 3, dependent 4. These are all qualified children. Just for our theory examples, we're just looking what the calculation will do according to the software. And we're going to say, all right, there's dependent 1, 2, 3, 4 for Smith. They're all child tax credit qualified according to what we have here. And so now we're back up to the 4,000. So it phased out. You know, if we look at the calculation, of course, we would see that we have 8,000, 2,000 times 4. That's the 8,000, but it's been phased out now, of course, now to only allow the 4,000 of it. And then, of course, what if we increase the income back over here? We're going to go back to our wages and say, what if we're now at let's say 290,000, back to the 290. Well, now we're at 3,500 with our 4 dependents. And then if we go back over here and say, all right, well, let's go to 300,000 with our 4 dependents. And now we're going to say, now we're at 3,000. Let's say we go up to wages of 310,000 back to our form. And we'll see that then we'll calculate at 2,500. So you can see how that phase out works. So in other words, the lower limit is 200,000, but it'll phase out from there. That's when it starts to basically phase out. Now, if we reset our return and say we're married now, so now we have a married return and 2 individuals, and so we have back to 1 single dependent for a married couple, qualified child. All right, what happens there if we have 400,000? The 400,000 for that 1 child, then we get the full credit of 2,000 because now it's twice the threshold. And then if we went up from the 400,000, we would see a similar type of calculation as we increase the wages from there. So now if we say we had, 420,000, we go back to the forms, then we're going to have a similar kind of decrease here. And as we add the dependents, we're going to have a similar type of phase out. But of course, the starting point of that phase out now being 400 rather than the 200,000. Now, there's also going to be issues on the lower limits, and we'll talk about them in a future presentation because that's technically going into the additional child tax credit. And we're talking here about basically the child tax credit. So we'll go into more depth on the lower limits as we go to the additional child credit. But just notice that, of course, if we go to a liability that goes where the liability is 0, so say we made 24,000 for a married couple, then we go back over and we're going to say now there's no tax liability because what happened here is that we have the adjusted gross income at 24,000, the standard deductions at 24,000. So there's no taxable income and therefore no tax. No tax is owed. And therefore, there's no child tax credit in this case. Now, we have this additional 8812, and we'll talk about that later. That's the additional child tax credit. We're to increase a bit here to 24 to 30,000. Then, if we go back to our forms, now we owe a little bit of tax, right? Because we had 30,000, 24 standard. Our taxable income is 6,000. We owe 603. So we owe 603, but then the child tax credit wipes out the full 603, because from a child tax perspective, this number is going to be whatever it takes to bring this down to 0. And then we might have an additional tax down here, which is going to basically give us money back even though we paid no taxes. So note that as we increase our income now to the 30,000 to the 40,000, we're going to say, all right, now there's 40,000. This is a married couple with one child. So we're going to get the 40,000 is reduced by the 24 to get to the 16. That's still below 2,000. So we're only going to get the credit up to the amount of liability to bring the tax liability to 0. Again, we'll talk later about the additional child tax credit, but that's where we are there. And then if we bring this up to 50,000, we're going to say, all right, what happens at 50? Well, now the tax liability is at $22,742, so we get the full child tax credit, because that still leaves us owing some money. And therefore we don't have anything down here in the 8812, because we don't have an additional child tax credit because we took the full child tax credit. Now again, if we added, what if we had another dependent? Well, what would happen then? We're going to say, all right, well, let's add a dependent. Say, well, now there's 2 dependents. So 2 dependents up top, both qualify for the child tax credit for our example. And we'll say, all right, well, what does that do? Well, now, of course, you would think it would be 4,000. The child tax credit, if we look at the calculation, would be 4,000. But we're not going to get the full 4,000 because now we only have a liability of 2,742. So this 2,742 brings it down to 0. We don't get the full 4,000. Plus, we might get an additional child tax credit, which we'll talk about that calculation down here later. So this calculation up top will basically bring us down to 0, and it's going to be 2,000 times the number of qualified children. We'll talk about what that means later. And then it'll be capped at whatever it takes to bring the liability down to 0. But that's not the end of the story, because then connected to that is the additional child tax credit, which might allow us money above and beyond that 0 liability amount. In this presentation, we will take a look at the concept of improper claims as it relates to the child tax credit. We may be thinking, as we consider the child tax credit, that's a pretty significant credit and it may be subject to abuse. People might lie about the child tax credit, in other words, in order to receive the credit. So, for example, we have the ghost child here and might have try to claim something that's not there and get the child tax credit. So what about those circumstances, and what are the consequences of circumstances like that according to the Internal Revenue Service? This is coming from publication 972, page 3. So you can get those in, I will provide those with the resources. So let's go to the text here. If you claim the CTC, child tax credit, the ODC, the other dependent credit, or the ACTC, additional child tax credit, but you are not eligible for the credit, and it is later determined that your error was due to recklessness, basically, almost on purpose, or you should have basically known better kind of recklessness. That's not a very defined term, but it's, basically saying that almost intentional, if not intentional, kind of recklessness. So that's just a loose definition of the term. Back to the text. Or intentional disregard. Notice again in the law, oftentimes this question of intention is always going to be a big point. So if they determine somehow, and again, this is difficult to kind of nail down on what it exactly means, but if it's intentional disregard, then of course that would be a more severe in terms of the law most of the time. Back to the text. Of the CTC, child tax credit, ODC, other dependent credit, or ACTC, which is the accelerated child tax credit, or additional child tax credit, not accelerated rules, you will not be able to claim any of these credits for 2 years. So that could be significant to a lot of people. So if there's abuse of it, then they're basically saying you're not going to get this credit, which could be a significant, $2,000 per child for 2 years. Back to the text. If it is determined that your error was due to fraud, now they're basically flat out saying it. So notice the terminology. Reckless, they're going to say, well, maybe it was maybe you didn't do it completely on purpose, but it's pretty reckless, and we think you should have, known better there. Seems pretty reckless. Or if it was intentional disregard, meaning, you just totally didn't put in the time to really look at it up to the standard possible, and these are loose definitions, I'm just kind of explaining the terms, then you're going to be subject to this rule. Now, if it's fraud, that again comes down to intention. So intent, that now they're saying that you purposely and maliciously or intentionally deceived. Fraud has an element of deceit, which again is something that's really, how do you know reckless versus intentional disregard versus deceit or fraud? Difficult to prove in court, but conceptually we know those things. We know what those things are. So in any case, fraud, intentional, it would be the most severe. You will not be allowed to claim any of these credits for 10 years. So then you don't have the credits for 10 years. You also may have to pay penalties. So obviously, fraud would be something that could be subject to penalties as well, and that would be the more severe than a mistake. But you want to avoid any of that typically, because again, these are difficult terms to prove, and you'd rather not be in the position where you have to prove one of them or the other. Just you kind of want to avoid any improper reporting of it. So, and then we'll go back to the Form 8862 may be required, back to the text, if your CTC, your child tax credit, or the ACTC, the additional child tax credit, for the year after 2015, any year after 2015, including the currents, was denied or reduced for any reason other than a math or clerical error, you must attach Form 8862 to your tax return to claim the CTC child tax credit, ACTC additional child tax credit, or OCD, which is the other dependent credit, unless an exception applies. See Form 8862 and its instructions for more information, including whether an exception applies. Bottom line then is it's best really to, when you're filling out this information, to go through the rules for the qualified child, make sure that we have the qualified child, we're filling out the information properly as we enter it into the tax return, and be aware that the Internal Revenue Service is sensitive to abuse in this area, because of course it is an area that probably is more subject to abuse given the nature of the type of credit it is, and therefore you want to be more diligent to make sure that you're entering the information properly. In this presentation, we will talk about what a qualified child is with regards to the child tax credit. Up to this point, we've been talking about the amount of the credit, some of the limitations for the credit. We've been talking about a qualified child to qualify for the tax credit. So now we want to determine, of course, what is it specifically to be a qualified child? What are the qualifications for the qualified child? This information can be found in Publication 972, which we'll provide in your resources. Back to the text. A child qualifies for the CTC or child tax credit if the child meets all of the following conditions. So here are the conditions to qualify if it's a qualifying child. So remember, as we go through these, the idea is that we first think of kind of a dependent. We want to think, all right, is it a qualifying child? Because if it is, then there's huge credit that we want to think about, up to $2,000 per child. If it's not, then you want to think about whether or not the dependent qualifies for the other dependent credit. So those two credits are kind of connected. So anytime we have a dependent, this is kind of the thought process you think. You go, all right, well, is it a qualifying child? Because if so, you got this credit for the child tax credit, or possibly the additional child tax credit. And if that's not the case, then you may get a credit for the other dependent credit. So that's how you want to think of it. We'll talk about questionnaires for that later. So here's the general rules. We'll go through the questionnaire that applies these rules in a later presentation. Number 1, back to the text. The child is your son, daughter, stepchild, eligible foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or descendant of any of them. For example, grandchild, niece, and nephew. So that's going to be condition number 1 for the child tax credit. Then we have condition number 2, back to the text. The child was under age 17 at the end of 2018. So notice that we have the specific age of 2017 at the end of the tax year. We're talking about 2018 tax year at this point. So 2017 by the end, under 2017 by the end of the tax year, current tax year being the 2018 tax year. So note that this is a different requirement than the requirement to be a dependent, because it's possible to be a dependent and not a qualifying child. So we'll talk a little bit about that later. In other words, if they're older than 17, then may not get the child tax credit, but still may qualify as a dependent and may qualify for the dependent credit, other dependent credit. Condition number 3, back to the text. The child did not provide over half of his or her own support for 2018. Again, we're thinking about tax year 2018 here, and that means this is going to be the amount of support they provide. So if they provide more than half of their own support, then they don't typically qualify for the child tax credit. And again, these are different than the dependent credit requirements, but note you'll see some kind of ringings of similarities between the two. So the child tax credit did not provide over half of his or her own support, because if they did, then you would think they would be more dependent on themselves, and therefore not be something that should be triggering a child tax credit. That's kind of some explanation or some justification, some looking for reason in the tax code, which may be a futile event. But in any case, number 4, back to the text. The child lived with you for more than half the year 2018 for the math. So the year 2018. So in other words, 2018 being the tax year we're talking about, they lived with you for more than half of the year. Now, there could be some exceptions to the time limit that lived with you. So if you have some unusual circumstances, then you can go into and look at the exceptions to the rule for that particular area of living with you. So if there are some exceptions, some strange kind of circumstances where if you meet 1 through 3 and not the 4th condition, then you want to go and explore some of your specific kind of conditions to see whether or not you can meet those exceptions to the rule. Condition number 5, the child is claimed as a dependent on your return. So we can see publication 501 for more information about claiming someone as a dependent. So notice that these rules here do not apply. They're not the same as the dependent rules, but the child needs to be a dependent in order to qualify for the child tax credit. In other words, to qualify for a child tax credit, the child that would be qualified must also be a dependent. However, to be a dependent doesn't mean necessarily that they qualify for a child tax credit, right? It works one way, but not the other. If they qualify for a child tax credit, they must be a dependent. If they are a dependent, they may not qualify for the child tax credit. And if they don't, then you're looking to see if you can get the other credit, the other dependent's credit. Number 6 requirement, back to the text. The child does not file a joint return for the year, or files it only to claim a refund of withheld income tax or estimated tax paid. So in other words, the general rule here is, of course, that they don't file a joint return. And if the child files a joint return, why would they file a joint return? It would mean that they're married. So that would think that if someone is married, if they meet all the other requirements, meaning you would think they wouldn't be married typically under our culture because they would be under 17. So you would think they wouldn't be married and that this wouldn't be an issue. However, if there is a situation where they meet all the other requirements and they file a joint return, that would indicate typically that they're married. And if they're married, then you would think they're not dependent, and therefore they probably wouldn't meet a dependence rule. But even if they did for whatever reason, the specific rule on the child tax credit rule would be that if they're filing the joint return, would not typically be eligible, with the exception here that you can then research that exception if it's applicable to you. Next item, number 7, back to the text. The child was a U.S. citizen, U.S. national, or U.S. resident alien. For more information, see publication 519, U.S. Tax Guide for Aliens. If the child was adopted, see adoption child. So if this applies, if there's questions about the U.S. citizen, U.S. national, or U.S. resident alien, then you can look for more guidance with regard to that information with the U.S. Tax Guide for Aliens. If it's an adoption situation, then you can go specifically to the adopted child. And again, you could find links to this information on the publications, or just go directly to the IRS website and research that information. So here's going to be the exceptions to the time lived with you. So you'll recall we had that rule that they got to live with you for the majority of the year. Or specifically, if we jump back to Rule 4, the child lived with you for more than half the year, and 2018 being the year we're talking about, the taxable year. So here's going to be some of the exceptions. We'll go to the text here. Exception to the time lived with you. A child is considered to have lived with you for more than half of 2018 if the child was born or died in 2018. So of course, that's going to be the first exception. So in other words, of course, if the child was born in the middle of the year, then that's going to be accepted. They didn't live with you for more than half the year, at least not, out in the house or something. So that would be an exception. If the child died in the year, then of course that would be those exceptions. So back to the text. And your home was this child's home for more than half the time he or she was alive. So when they were there, whether unborn or before death, if they were there for more half the time during the year of that time period, then that would be one of the exceptions. So back to the text. Temporary absences by you or the child for special circumstances such as school, vacation, business, medical care, military service, or detention in a juvenile facility count as time the child lived with you. So obviously when we're thinking about they lived at home, we don't mean necessarily that they physically were in the house all the time, but that was their basically kind of, you could think of it, this is my terminology, of kind of like their primary residence. So obviously if they're somewhere else on vacation or they're going to school somewhere else, but their primary residence, their home in essence, is there, then that would be kind of a separation from the rule. So it doesn't mean clearly from the most technical sense, or it doesn't mean necessarily that they spend that amount of time under the actual roof. In other words, there's going to be exceptions, and they would be the ones that you would most think would be the most common oftentimes, where the child is outside but still thinks of basically, or that being their principal residence. So that's kind of, again, my variation on the wording of this exceptions of the rules. In this presentation, we will use tax software to check some scenarios for a qualified child with regard to the child tax credit. Here we are in our test 1040 with our sample single file with Adam Smith and the mock social security number. We have the dependents. We're going to go back to one dependent, and currently we have the qualified child, and we're going to test some of this information by kind of tinkering with the software for the requirements for that being the qualifying child. So when is it not going to be basically a qualifying child? We'll do some tinkering with the software and see if the software can give us some guidance with this, as most software typically will help us do. And now notice we have the calculation with that basic example where we do have a qualifying child, $50,000. We have the standard deduction, $12,000. We have the $38,000 taxable income then. And then we have the tax, $4,373, and then the deduction, the child tax credit, $2,000 to bring us to the $2,373. So that's going to be our basic example. Now we're going to go back over here and say, all right, well, let's go to these dependents then. Here is our first dependent. We have a mock dependent here, and take a look at some of these adjustments. Now we have the son, of course. We know that the son and daughter, that's the first thing that we'd have to take a look at. Those two things qualify. If we go back up to the software, they're not basically going to remove it if it's the son or daughter. So if clearly the son or daughter would be acceptable as a child tax credit to qualify for the child tax credit. We had some other relations that qualify as well. So for example, if we have the stepchild, so if this was a stepchild and we go, all right, let's go back to the form, is the software going to basically indicate that that's not good? No, we still have the $2,000 with the stepchild. So stepchild, basically the software is going to qualify as, and this isn't an assurance that something is going to be, I'm just using the software to kind of guide us, as often is useful to do. So we're just tinkering with the software and say, okay, well, what if we change it to stepchild, and just see what the software will do if they give us any errors with it, which isn't an indication of the law necessarily, but it gives us some indication oftentimes. For example, what if we said none? We're going to say none of these relations apply. We have a child that doesn't qualify for any of those relationship tests. Then we're going to say qualified child, no, typically not, right? So if none of those tests qualify, then we're going to say, all right, not child tax. We're going to possibly lose the credit in that case, but still get the other dependent credit possibly. And we'll talk about that later. So if it was, nothing, no relation, but we're taking care even if they qualify as a dependent, in this case we're saying they do, then we'll lose the child tax credit, but we may still get some benefit instead of the $2,000 in this case, possibly the $5,000. Now we'll say, okay, how about a foster child? Foster child, if we go back to the forms, and we're going to say, well, what does the software do with foster child? Qualified, right? And that would make sense. So we got the $2,000 for the foster child. So that looks good. How about a grandchild? We're taking care of the grandchild. Does the tax software give us any triggers away from us on the grandchild? No, we still get the child tax credit. Basically a kind of relationship test there for the grandchild. Now, of course, something like a grandparent wouldn't make sense, right? Because then they wouldn't fit the age, they wouldn't meet all the requirements because clearly the age, they wouldn't be under 17 typically. But I mean, if you chose something like that, you have a relationship, and if they met everything else, it's obviously still not going to be there. And again, this would be a funny situation because we said that they're going to be very young for a grandparent. But just note, of course, that would say, okay, not credit on that item either. A not so extreme example would be mother, right? Mother and father. So again, wouldn't be meeting the age requirement either. So, but even if we put in the software that they meet the age requirement, the software would say no. That would possibly qualify for the $500 other dependent, not the child tax credit possibly. So not the $2,000, possibly $500. How about nephew or niece, nephew? If we go, all right, if they meet everything else, then we're going to say tax software says, according to we're just testing the software. So it's going to say, yeah, they don't automatically rule it out for the child tax credit if everything else was met for the niece and nephew, or nephew in this case. How about a sister? If we have sister, we're going to say, all right, sister. And again, there'd be, of course, an age difference on the sister. We're going to say, okay, software's not taking it away for the sister. So those are some of basically the relationship type of tests. Now let's change something else. We're going to say, all right, the relationship test, we're going to say son, that's clearly met for the child tax credit. But what about the age limitation? We said that was 17. So let's say we're tax year 2018 minus 17 years. So let's say that's 2001. Let's say they turn, I think that would mean 17. If I'm doing this right, we're going to say 2017, they would turn at the end of the year, December 31st, 2001. That means at December 31st, 2018, the current tax year, they turn 17. I believe that's correct. So, and we have to be under 17. So if that's the case, we're going to go back to our form, and they go, nope, you turn 17. I was before the time period. If we scroll down, we get no child, but might get that 500. And we go, well, what if the date then was January, they were born on January 1st, 2002, the next day. And then we're going to say, all right, well, if we go back to the software, they're going to say, well, then you're good, right? Now we're good because they're under 17 as of the end of basically, the tax year. So just be careful with that item as well. So now we have the qualified child and the 2,000 on the credit. In this presentation, we will talk about how to claim the child tax credit. This information can be found in publication 972, which will be in your resources. To claim the CTC child tax credit or the ODC other dependent credit, be sure to meet the following requirements. These are going to be the requirements back to the text. You must file the Form 1040 or Form 1040-NR and include the name and TIN, tax identification number, of each dependent for whom you are claiming the CTC, child tax credit, or ODC, other dependent credit. So of course what this means is we've got to file our taxes. The tax form for individual filing being the basic form, the 1040 form. Note that in 2018, we have less complication with the Form 1040. We don't have as many kind of the 1040A or the 1040EZ. We have more of a standardized basic 1040 with other types of schedules that might be necessary for other needs that were on prior forms prior to this. So in any case, of course, we have to file the 1040. We have the name and the tax ID number, the TIN number, of each dependent. So of course we will need the TIN number, which will normally be the normal tax identification number is the social security number for the dependents, and the qualified child. So the qualified child, which typically will be also a dependent. Next, back to the text, you must file Form 8862 if applicable. So Form 8862 is an information to claim certain credits after disallowance form. So you want to look if that's applicable to look at the instructions for that. Next, back to the text, you must enter a timely TIN, tax identification number, on your tax return for you and your spouse if filing jointly. So of course we need our TIN number, typically being the typical identification number, TIN being the social security number. Next item, back to the text. For each qualified child under 17 for whom you are claiming the CTC, which is the child tax credit, you must enter the required SSN, Social Security number, for the child in column 2 of the dependents section of your tax return and check the child tax credit box in column 4. So we're going to basically have to enter that information into the tax return and make sure that we have the proper information in there, and including typically the social security number. Next item, back to the text. For each dependent for whom you are claiming the ODC, which is the other dependent credit, again, we're focusing here on the child tax credit, but they're kind of related when you read through the items, because you would first think child tax credit, then if not, then the other dependent credit. Back to the text. You must enter the timely issued TIN, which is the tax identification number for the dependent in column 2 of the dependent section of your tax return, and check the credit for other dependent box in column 4. So we would basically be indicating the similar kind of information for who they are, now checking off that they're an other dependent rather than the child tax credit. How to claim the additional child tax credit. So the additional child tax credit, something that we typically think of as kind of part of the child tax credit, but the law is going to break it out because the child tax credit doesn't take the liability below 0. The additional child tax credit will then. So when we're thinking about the child tax credit, we probably just think of it in terms of these two things being the same thing, like when do we get it, but they're actually on two different line items when you look at the Form 1040. So we'll show some examples of that in the future. But to claim, back to the text, to claim the additional child tax credit, ACTC, follow the steps below. So now we'll talk about the additional child tax credit just in terms of the instructions on how to claim it, how we'll enter this, and we'll get into more detail about the additional child tax credit later. So number 1, back to the text, be sure you figured the amount, if any, of your CTC, child tax credit, and ODC, other dependent credit, using the appropriate child tax credit and credit for the other dependents worksheet. So we'll first take a look at the child tax credit, other dependent credit, before considering the additional child tax credit. Next item, back to the text. If you'd answered yes on line 11 or line 12 of the child tax credit and credit for other dependents worksheet in the Form 1040 or Form 1040 in our instructions, or on line 16 of the child tax credit and credit for other dependents worksheet in this publication, and line 1 of the worksheet is more than 0, you schedule 8812 to see if you can take the additional or the ACTC, which is the additional child tax credit. So in essence, if you go through this worksheet, we're going to get to the line item that's going to determine whether or not we should basically move on to the additional child tax credit. And basically just in kind of words, as you go through this, you want to look at that worksheet. We'll look at some of the calculations in more depth, but just note that the child tax credit is going to take the liability in essence down to 0. So in essence, you're thinking your tax liability goes down to 0. And then if you have more available credit that you might be able to qualify for at that point, then we got to move on to the additional, which is the ACTC, or additional child tax credit, over and above, basically in essence past what your liability would be And that's kind of what the worksheet will help us out to do. Number 3, back to the text. If you have an ACTC, Additional Child Tax Credit, on line 15 of Schedule 8812, so Schedule 8812 is something that we're going to fill out if we're required to do so, basically if we have potential child tax credit above and beyond bringing our amount of liability down to 0. So if, back to the text, if you have additional child tax credit on line 15 of Schedule 8812, carry it from Form 1040, line 17B, or Form 1040NR. In other words, we'll calculate the additional child tax credit on the Schedule 8812, and any child tax credit there will carry forward to the Form 1040, which we'll then see it on 1040, which will then help us to calculate the actual refund or amount due at that point in time, probably a refund if we're filling out the additional child tax credit, or amount that we're going to get back, even if we didn't pay money in that case. So we'll take a look at those forms in future examples. Number 4, back to the text. For each qualifying child under 17 for whom you are claiming the ACTC, Additional Child Tax Credit, be sure to enter the required SSN, Social Security number, for the child in column 2 of the dependents section of your tax return, and check the child tax credit box in column 4. In this presentation, we will discuss more specifically the additional child tax credit. Most people, when thinking about the child tax credit, probably think and combine together the rules for the additional child tax credit and the child tax credit, but we think of them distinctly when we look at the way the IRS has put together the forms and put together the wording of the laws and regulations for child tax credit, and now we'll be taking a look at the specifics of the additional child tax credit. This information can be found on publication 972, which will be in your materials. We'll start here, back to the text. This credit is for certain individuals who get less than the full amount of the CTC or the child tax credit. The ACTC or the additional child tax credit may give you a refund even if you do not owe any tax. That's going to be the major difference. So that's what the ACTC is, the additional child tax credit, as opposed to the child tax credit. So the code says, or the way the law is written, it says that, hey, the child tax credit can only take you to 0 in terms of tax liability. And that would be typically the case, because if they give you money back beyond going to 0, then you didn't pay tax. We got something other than taxes. We got some kind of benefit, some kind of program from the government that gave us money, instead of it being a refund. So that's in essence what the ACTC is. The additional child tax credit isn't really a credit. It's giving us money over and beyond the amount that we owe. So we don't owe taxes, we're getting money back. So that's why they had to make the distinction. That's why it's basically in 2 separate line items. But when we're considering it, we probably think of it as the same thing, meaning, you know, what's the child tax credit? We have a lower kind of limit, a limitation, and that is basically based on the liability for the credit that we're going to get. And when we go past that limitation, we switch from it being called a child tax credit to the additional child tax credit, and we got to make sure that we qualify for any kind of qualifications if our tax liability then goes below 0 in essence. Back to the text. The ODC, or the other dependent credit, cannot be used to figure the ACTC or the additional child tax credit. Only your CTC, child tax credit, can be used to figure the ACTC, additional child tax credit. If you are claiming the ODC, additional other dependent credit, but not the CTC, child tax credit, you cannot claim the ACTC, additional child tax credit. So what does that mean? They're saying, look, if you have the if you're talking about someone that has the ODC, what the general rule goes like this. We're trying, if you have a dependent, first question, can I get a child tax credit, which is up to $2,000? Then we're going to say if no, then if we say, hey, they're not even, you know, we're not going to get a credit at all, but we're going to go for the ODC, other dependent credit, which is only $500, then we would be looking at that $500. However, if the $500 brought us below the tax liability, then we're still not going to get that's not going to qualify us for the additional child tax credit. Meaning, if they're not a qualified child and we're just got a other dependent credit, then if we go to 0, we're probably basically stuck there. We're not going to get any refund. We're not going to get any part of that $500. But if we're saying it's a child tax credit and it went to 0, so therefore we don't get the child tax credit, then we may qualify still for what they call the additional child tax credit, which means we might get some beyond that. So in other words, the additional child tax credit doesn't qualify for something that's just a dependent and not a child tax credit, which would kind of make sense, you would think. So then if we keep rolling back to the text, foreign earned income, if you file Form 2555 or 2555EZ, both related to foreign income, you cannot claim the additional child tax credit. So if there's going to be restrictions on the additional child tax credit if the income isn't U.S. if you have non-U.S. income. So it's something to be aware of and careful about. So if that's an issue, if you're not getting the child tax credit, look into that foreign income as possible reason why that might be what's going on there, and look into that further if it's applicable. Next item, back to the text. How to claim the additional child tax credit. To claim the additional child tax credit, or ACTC, follow the steps below. Number 1, be sure you figure the amount, if any, of your CTC, child tax credit, and ODC, other dependent credit, using the appropriate child tax credit and other dependents worksheet. In other words, how are we going to get to the additional child tax credit? You got to first figure out what the child tax credit is. In other words, do we have the qualified child, and what would the child tax credit be, and then the limitation on it. Of course, if it's $2,000 and there's a limitation on it, we'll find that out in the worksheet. And if the limitation is due to a liability limitation, in other words, we don't owe any tax beyond a certain amount, we owe tax something lower than the $2,000, then that's going to be our first step to determine whether we go to the ACTC, if we could still get some money back from the additional child tax credit. So in order to do that, then first step is to figure out the child tax credit, which could be limited by the liability. Number 2, if you answered yes on line 11 or line 12 of the child tax credit and credit for other dependents worksheet in Form 1040 or Form 1040 in our instructions, or on line 16 of the child tax credit and credit for other dependents worksheet in this publication, and line 1 of the worksheet is more than 0, use Schedule 8812 to see if you can take the ACTC, or additional child tax credit. So what does all that mean? So basically it's saying that the worksheet will help you, and of course tax software is useful to help you to get these worksheets to filled out and help you to fill them out, but they're going to say the tax sheet's going to help you to determine whether or not you need to file Form 8812, and the determination will typically be that you would qualify for the child tax credit, but you're limited by the amount of liability, and that would help you to determine that you need this other schedule, which hopefully, again, tax software would be very useful to help with this, which would be the Schedule 8812 to see if you have, and that's the schedule related to the additional child tax credit. Number 3, back to the text. If you have an ACTC, additional child tax credit, on line 15 of Schedule 8812, carry it to Form 1040, line 17B, or Form 1040 NR, line 64. So that basically means that we're going to fill out the additional child tax credit form, which is Schedule 8812, and then we're going to take the bottom, whatever that comes to, and bring it to the Form 1040. It's on a different line as the CTC, child tax credit, as we'll see when we go to our example tax return, but it's going to be on the 1040 because that's where we need it to be to get to the baseline calculation of the tax that will be owed and or refunded, probably refunded in this case, or amount that we're going to get in any case. Number 4, back to the text. For each qualifying child under 17 for whom you are claiming the ACTC, additional child tax credit, be sure to enter the required Social Security number, SSN, for the child in column 2 of the dependent section of your tax return, and check the child tax credit box in column 4. In this presentation, we will use tax software to consider the calculation of additional child tax credit, running some scenarios for it to see what the tax software will do with it, and consider the implications as we change the data input on the calculation of the additional child tax credit. Here we are on our test 1040 with our simple single individual. We have the single individual, Adam Smith, who got the mock social security number. We're starting off with the one dependent. So this is going to be our start off point. We have the one dependent. We're saying that that dependent is checked off as the child tax credit box rather than the credit for other dependents. Therefore qualified. We have the income. We're saying this is a flat $50,000 for the single individual W-2 income. And therefore we have the standard deduction, and therefore the taxable income is $38,000, and the tax then calculated by the software is $4,373, and that gives us the tax of $2,000. So note what the issue, now this is going to be the flat CTC tax on line 12. We have a flat CTC tax. We're not talking here about the additional child tax credit. And note, they're kind of related, but what we want to think about is this item versus this item, which is on 8812. We don't need this item because if we consider the worksheet, we say, all right, well, the worksheet is okay because we basically have more of a tax liability than the amount of a credit here. And therefore, we can have the child tax credit, the full amount of the $2,000, and we don't have any of the 8812 item. And that's because this number, the liability, not counting anything in terms of our payments. The payments are down here. This doesn't have anything to do with how much we withheld. We have no withholdings right now, but it wouldn't change if we had withholdings. And we could show that if we go, okay, well, what would happen if we had withholdings and we say we had 50,000 and we withheld a whole 10,000 on it throughout the year, and that was taken out of our paycheck. Well, it didn't change this number, or this number. It did change the refund amount because now we're getting refunded that amount that we overpaid. But the liability is up here. So that's the thing that we're concerned with. So I'm going to go back just to not muddy the water and say that we take away the withholdings, and that'll kind of make things a little less muddy, a little less messy. So here we have this, and that's going to go in. Now, the issue, when are we going to go to this form, this 88-112? Well, it's when this liability amount is more than the credit. So either we have the credit go up, which means we might have 2 qualified children, or the liability goes down, right? So let's say the liability goes down by we have less wages. So let's go back to wages and say we only earned 40,000 and see what that does to the tax liability. So now the tax liability goes down to 3,173, still above the 2,000. We're still okay. Note that you might observe down here that we do have an earned income credit, and that's another credit that could take us basically below a liability and get a refund or get money even though we don't have a tax. So we're not talking about that now. We're going to leave that alone. What we're concentrating up here right now is the fact that this amount is above the 2,000, and therefore it's bringing down our liability. So we still have some liability up top. That's what we're concentrating on here. Let's go to 35,000, and we'll say, okay, now we're at 2,500. This is what we owe. We're still okay because that brings my tax down to 573. Again, we didn't make any we're not talking about any withholdings. We're saying that we owe taxes now, whether we withheld or not. It doesn't necessarily mean we're getting a refund or not of the 573 is how much we would owe, whether we paid it or not. So let's go back over and we're going to say, all right, now we're going to say that we're at 30,000. So 30,000, that's going to be our income. And then that brings, so our income is at 30, and that brings the liability down to 1,973. This is the liability before the credit, and therefore this credit is bringing it to 0. So now we have the child tax credit. We have this situation where, okay, the credit amount to 2,000 max is below the liability amount. You can see the worksheet here to see the calculation of it. There's the difference. And so now we're considering, okay, so now we got to go to basically the second schedule. So now you'll note that this piece and this piece are related. The 1,973 is now kind of tied together with this item. This is the additional child tax credit, which is dependent on the child tax credit calculation. So in other words, if we think, all right, it should be $2,000 for the child tax credit or the additional child tax credit, we got the, okay, 1973 plus the 27, and there's going to be our $2,000. So why do they have to break it out between these two? Because this bottom one is telling us that this is going to be below zero, and there's different limitations to that when that's the case. So now to get that then, that calculation, now we have to go to this form 8812, which now became populated, something we have to fill out. Here's the form 8812, which we basically start off with the credit of the 2,000. Note the limit here is 1,400. So this additional child tax credit cannot go above that 1,400, and then you can go through the calculation, which of course is the 27 to bring it up to kind of basically the max of the 2,000 between the two. It's kind of how you can think of it. So if we go back up to the 1040, well, what happens if we keep reducing the wage? Let's go to 25,000 and say, all right, at 25,000, then our tax liability or our taxable income is 13,000. Our tax is only 1,373, and therefore that's going to be the same amount for the credit amount. And then we have the additional credit down here, which is the 627. So now we've got the 1,373 plus the 627. We're still going back up to that 2,000 total. This is the amount that's going to be refunded over and above the fact that we don't owe any taxes, right? The tax that we owed went to zero, and we still got 627 related to this back. Again, the earned income credit is separate. That's something that we could discuss at a later time. We're considering here this item, the 8812, and that would be calculated down here. That we get to the bottom of this form, that 627 is pulling over to the form 1040. And there it is on the 627 on the form 1040. What if we said, okay, well, what if we only had 20,000 of income? 20,000 of income, then we're going to say, okay, so now we have taxable income of 8,000. And so then we have the tax then of 803. So we're limited to 803 on the child tax credit, and that brings us to zero. But then, of course, we have this amount of the 1197. So now we've got 803 plus the 1197 is the 2,000. So, okay, let's go back over here and say, all right, well, what if we bring this down to 15,000? Say we go back over, well, if we're at 15,000, we got taxable income of 3,000. So, and that gives us a tax of 303. And that means we only get 303, the child tax credit. And now if we look at this, we're going to say, but now the 303 plus the 1400 only comes to 1,703. That's not the 2,000. Why? Because this one is capped. So that's the point of it bringing it down here. It's capped at 1,400. It's not going to go over 1,400. So this one could be up to 2,000 if there's taxable income. And then if you were not capping, if we're not using all this, then this item could be up to 1,400, and that's it. So in other words, if we lowered our income again to 10,000, we say, okay, what happens there? 10,000. Now we don't owe any tax because 10,000 is below the standard deduction. But we still had some income. We still had some earned income. With the government wants to incentivize us to have earned income. So they're still giving some benefit. It's not the 1,400, but they still have some benefit, 1,125. Let's say we go back over here and make it like 13,000. So if we go to 13,000, now we had 101 of tax, and this brings it to zero, and we still get that full 1,400. Let's bring it down to 12,000, and that should bring our tax, our liability to zero exactly, because our income matches now our standard deduction. Tax is at zero, no child tax credit, but we get the full amount still. Even though we have no tax liability, we paid no tax, we get the 1,400. That's the max. And you can see the calculation here on the 8812. That's going to be the max. And then if we lower income from there, this number is going to go down now. So if we lower income from there, we say, all right, we did 10,000. We saw last time, we're going to say, all right, now this number, we're not going to get any CTC, and this number is going down now. And that's according to the calculations here. So that's going to be according to this calculation. We start to phase out and lose the amount that we'd get refunded as we earn less income. So earning less income now is bad for the child tax credit. So if we go to 9,000, we're going to say, okay, now it went down to 975. If we say, all right, if we had 7,000, now we're only going to get back the 675. And then if we go, all right, what if we had 6,000? Now we're going to get back the 525 that we're getting. Again, we're not paying any tax on this, so this is all good. But of course, in terms of how much money we're going to get, it's going down as our taxable income now goes down. You might think that's weird. Why would it do that? You would think it, as my income goes down, I would get more kind of a welfare or benefit program. But it's an earned income program, so they want the earned income to be a certain level to facilitate earnings, is kind of the idea. That's my interpretation of it. At least there's 5,000. Then we got, it's down to 375. For bring it down to 4,000, that's going to bring down to 225. So we're still getting a benefit, but it's pretty low. And if we get down to 3,000, then if we go back to our forms, we're going to get 75. And now let's make it 299. 2999. We're going to get at the 75. And then I think it goes down to 2,500, actually, 2,500. That's the cap. And then it goes to 0. So let's go to 2,501. We go to 2,501. Then we don't have anything. But if we go to 2,599, then we get $15. So the low cap, you're not going to get anything past the 2,500 if you have no earned income. In other words, below 2,500, then you don't get any of this credit. But then it actually increases as the taxable earnings go up from that point. Now, if we start from the same point, if we say, okay, let's go back to the 50,000 and say we earned 50,000, so we get the full credit. We're at 4,375 of tax now, so we get the CTC, and we get nothing over here on the 8812. Now let's think about, well, what would happen if instead of me lowering this number, I increase the number of dependents. So instead of having 1, we have 2. We'll go, okay, well, so now we're going to say, how about the dependents go up? And we say we got a dependent 2. So dependent 2 goes up. And so now we have 2 dependents, and they're both qualify for the child tax credit, we're saying. So now you would think you'd get 4,000, which would be, right, 2,000 times 2 dependents. You would get the 4,000, and that's our liability is 4,373. So that's over the liability. Therefore, we're good, right? So we're good there. We're still good. Well, what if we had three qualified children? We'll say, all right, well, let's do 3 qualified children. Say forms. So now we're going to say, now we got 3 qualified children's originally named, dependent 1, dependent 2, dependent 3. And we've got now a limitation, because now you would think it would be 246, right? If we look at the worksheet, you'd have 6 $2,000 child tax credit. But of course, even with the same wage, 50,000, it's limited now. Our liability is only 4,373. We're limited to 4,373 rather than the 6,000. And that takes us down to the child tax credit being 0. However, now we have this 8812 again. So now the 4,737 plus the 1,627 gives us the 6,364. And that doesn't make sense. So let's try that again. I would think it would be 6,000. 4,373 plus the 1,627 is the 6,000, right? Between these two. Because we have the 3 dependents times 2. That's what it's going to be. And if we go to the worksheet on this form 8812, now we've got the 6,000, right? And then the cap now is 1,400 times 3 that we could get to for those dependents. The maximum, in other words, the maximum of this number. So now let's say, okay, well, what if the income now goes down, we'll say, all right, well, the income now we're going to say is 12,000, which means we have no tax liability. Say, okay, well, the income now went to 12,000, no tax liability, no CTC at all, and we've got 1,425. So 1,425 there. Now let's increase it and say, okay, well, what would happen if we had 15,000 of earned income? We're going to say now we've got a 303 of the liability, which means the CTC is at 0, and we're at 1875. So again, if you go to this form, you'll see the calculation. You would think you can get to 3 times 1,400 some way, right? Because that would be the max cap that would be at. So let's go back over here and say, all right, we got 3 dependents. So we're going to say that that is it. Let's increase the income and say, all right, well, what if we had 20,000? 20,000. And that's going to give us this bringing us to 0 here. And now we're at the added 2623 or 2625 on this item. And then if we bring it up, we're going to say, all right, how about 25,000 of earned income? We're going to say, all right, 25,000. That's going to bring us a liability up top. And then the child tax credit, bringing it back down to 0. And now we've got the 3375 that's going to be added to it. So note the 3375 is the 1373 plus the 3376. It's not at the 6,000, of course, at this point, because we're being limited by it. And so if we go back over, we say, all right, how about 30,000? We're going to say back to the forms. So that would give us a liability here of 1973, bringing us the credit of 197320. And now we're at 4,027 on the additional child tax credit. 1973 plus 4027 is our 6,000. So these two now adding up to basically the 6,000. If we take the 4027 divided by 3, we're almost at that 14, right? Which is, if we go to this tab, you would think you'd get 1400 times 3, which would give us the 42, right? 4,000. So we had 1400 times 3, which would give us that 4,200. So you would think that would be kind of the max of the additional child tax credit you can get with the 3 children. So in any ways, hopefully that gives you some kind of idea as we tinker around with it of the interplay between the child tax credit and the earned income credit. And obviously what happens is there's going to be an interplay between the amount of taxable income we have here and then the amount of the credit that could potentially be there, and the maximum credit could go up if there was more children that qualified by 2,000 per qualified child, and or the income could go up or down based on, just basically what the income is. And then the interplay between those numbers will result in what happens down here on the 8812. And obviously, if everything kind of matched out, then these two would come out to what you would think, which would be, if there's one child, they would add up to 2,000 and whatnot, unless there were further limitations, which means you would end up between those two being less. This item down here, of course, having those further limitations. So anytime your tax, whether it be one child, 2,000, two child, 4,000, is greater than the liability, then you're going to be jumping down here and determining if you have this 8812 additional child tax credit, which is going to be limited to the 1,400 times the qualified children. That's going to be one of the first primary limitations that you'll encounter, and then you'll go from there to figure out if you get any of the additional child tax credit. This credit going above and beyond giving money back to taxpayers who didn't pay tax, right? Taxpayers who aren't paying taxes that are getting money back above and beyond tax liabilities. In this presentation, we'll take a look at a worksheet related to the child tax credit. We won't go through each line of the worksheet, but just note that the worksheet can be found in your resources and in publication 972. So here is the worksheet. We'll go through it slowly here so you can take a look at it. Again, we won't go through it line by line because we will show the calculations and give the idea of them as we go through and implement this into examples within the tax return. And there are, of course, going to be example worksheets like this worksheet in essence being part of the most tax programs. The tax program will, in essence, have the worksheet in it to help with the calculations and help to automate that calculation for taking this worksheet calculation and putting it into the software. So if you were to do this by hand, then, of course, you can go through the step-by-step through the worksheet. Can be very useful to do it because if you do this for a few different scenarios, then you get a good idea of what the differences are. And once you get the calculation of the differences, then what you want to do is be able to then explain that in words with people, because most of the time what we have to do is talk to people with words, not like a set of calculations. And that means we have to use a lot of simplification and scenarios and analogies and whatnot in order to put this into something applicable. So fill out this worksheet with a few different scenarios with different types of scenarios. Of course, you'll recall that the scenarios related to the CTC, child tax credit, is going to be related to then whether or not you got to move forward to the additional child tax credit. So you could be considering basically two kind of worksheets, one for the CTC and the second for the additional child tax if and when needed. So if you go to the tax software, then a lot of tax software, whether they give it to you or not, it'll provide you with a worksheet in one way or another. So for example, if we entered this into the tax software, the child tax credit is line 12. So if we go to line 12, we'll see a worksheet, and this is one type of tax program. You may have your worksheets displayed some other way. Here's worksheets over here that you can get to depending on the tax software. But the tax software is doing the same kind of calculations, of course. And then you can go through here and kind of reverse engineer. In this case, we had 2,000 times 3 of the qualified children for the credit of 6,000. You can go through, you could see this married filing joint or single limitation for the income type of limitation if there's a phase out, and comparing that to the taxable income. And you could go through the calculations here. Then the major limitation in this example being the fact that there's a liability that's less than the 6,000, and that's going to help us determine whether or not we need to move forward and do the additional tax calculation. So notice here, of course, that we had a liability or the amount of the credit was 6,000, and the amount of the liability was only 1,973. So then we had to go forward to the next calculation, which in essence is the 8812. So here's form 8812 now, where we go through, and this is the additional child tax credit of the 6,000, and starting at that point, the 3 times the 1,400 would be the max amount of the additional child tax credit in that case, and you can go through the calculations there to get to the additional child tax credit. Those then being reported on the 1040. So the 1040 child tax credit line 12, additional child tax credit, the 8812. So you can go through those worksheets, and you could find those worksheets in the resources. But however, of course, it's very nice to have tax software to help you with those worksheets as well. And then you can kind of reverse engineer the worksheets. The software will help you will generate many of the calculations, and then you can go through and kind of figure out what exactly those calculations are, why they are the way they are, verify them, double check them, and then be able to communicate them. In this presentation, we'll take a look at resources recommended by the IRS, the Internal Revenue Service, for getting help with things like the child tax credit and other tax-related issues. Note that there are different places we can go to get help with things like tax preparation. One place would, of course, be a third party, someone we pay to help us give us advice and to help us to fill out the tax returns, and or something that would be helped from the IRS directly, going to the IRS where we're going to submit the returns and trying to see if there are resources to give us help there. Both of them have their pros and cons, and as someone who's worked in tax preparation, I'm obviously biased towards the tax preparation or the advice of the tax preparer. But of course, although they have a financial interest, they're not within the IRS or the Internal Revenue Service, the government. And of course, when you're talking about people within the government, you're dealing with people that are, they're directly related to the tax receiving part of the information. They're also going to be a bit more bureaucratic in the nature. So I'm obviously a little bit biased towards getting advice from someone, a paid tax preparer or something like that. It always kind of felt like, going to the IRS to get tax advice is like, walking up to the door of the Death Star to ask how much you owe for taxes. But that's probably a little bit unfair at the same time. It's probably more like going up to just a bureaucratic agency most of the time and asking for information, and sometimes you get good help and sometimes you don't get as good a help. But in any case, these are going to be advice that's given on the publication 972, and they might be applicable at least places you want to go. You might want to go to a couple different places just to think about what the best place to find help would be. So this is from publication 972. Back to the text. Find free options to prepare and file your return on the irs.gov or in your local community if you qualify. So some of these, of course, will give help with the tax preparation for people that qualify for that preparation. So that's going to include, back to the text, the Volunteer Income Tax Assistance, VITA program, offers free tax help to people who generally make $55,000 or less, persons with disabilities, and limited English speaking people. So again, I don't have a lot of direct experience with the Volunteer Income Tax Assistance program, but it sounds like it could be a good program. And if you have, qualified volunteers, it probably, of course, depends on which volunteer you get to help you out with your taxes and in terms of how much help you're going to get. And I'm also not sure how much tax advice they would give as opposed to just tax preparation. So if you're asking, what should I do in this case or that case, how much kind of advice they might give, or if they, probably more likely to basically just take the information and just kind of input it into the system. So if you're looking for questions about this or that, or whether you should do this or that, I'm not sure how helpful they would be. But if you just need to, I would think they'd be more helpful just if you need to I just want to prepare the returns with what I got, and here's what I got, help me prepare the return. So I would think it could be useful for basic returns. If you have more complex kind of questions, might be useful. It'd be nice to be able to find someone else to give you advice on those types of questions. But again, this limited experience here, so it might be worth looking into if that's something that would be applicable. Back to the text. The Tax Counseling for Elderly program, the TCE program, offers free tax help for all taxpayers, particularly those who are 60 years of age and older. The TCE volunteers specialize in answering questions about pensions and retirement-related issues unique to seniors. So if you're in that situation, you're considering these two options, you probably definitely want to be here because that's going to be kind of a specialized kind of field. There's going to be different type of tax scenarios related to that. You want to make sure that you're talking to someone that, has some experience there. Again, might be great to talk to someone that's outside as well, but if you're talking to either of these two areas, then of course, if you're in a situation where you would qualify possibly for tax benefits due to being elderly, or then you want to make sure that you're talking to someone that has experience related to that. Next item, back to the text. You can go to the irs.gov to see your options for preparing and filing your return, which include the following. irs.gov is the website, so if you put that into the browser, irs.gov instead of .com, irs.gov, then that's going to be the IRS website. Good place to go to get a lot of good stuff, good free references. Back to the text. Free file. Go to the irs.gov/free file to see if you qualify to use brand name software to prepare and e-file your federal tax return for free. So again, another option. I don't have a lot of experience with it, but it might be worth looking into. So check that out, irs.gov website. VITA. Go to irs.gov/VITA. Download the free IRS To Go app or call this number to find the nearest VITA location for free tax return preparation. Again, I don't have a lot of experience with that, but it might be something to look into if it's an option for you. Then we have, back to the text, the TCE go to the irs.gov TCE, download the free IRS 2 Go app, or call this number to find the nearest TCE location. Back to the text, getting answers to your tax questions on irs.gov. Get answers to your tax questions anytime. So we have some resources for that once again on the IRS website. If you go to, back to the text, go to irs.gov/help for the variety of tools that will help you get answers to some of the most common tax questions. Normally the IRS website's a bit overwhelming. Of course, there's a ton of information. But if you have a specific question and you know where you're going, sometimes they have some tools that are good, like tax calculators for particular things and whatnot, that can be useful. So if you have specific questions, it's good to browse around basically the IRS website and use some of their calculations. If you're going there just to try to figure things out in general, you probably will be overwhelmed because, of course, it's dealing with a lot of tax law type stuff. But it's a useful resource for sure. And back to the text, go to the irs.gov/ITA for the Interactive Tax Assistant, a tool that will ask you questions on a number of tax law topics and provide answers. You can print the entire interview and the final response for your records. So again, this is a kind of a question and answer type of information as an attempt to have an automated type of system, a machine, but they can basically customize more towards your particular circumstance. So it might be worthwhile to go through that and ask some questions with that. Maybe even as a preparation to go to see some of these other tools where you might get some live help or talk to somebody like a tax preparer who, again, even they're often have a lot of limited time as well. So if you go in, the more knowledge you have on yourself and then go talk to someone, whether it be IRS related or some other related individual that you're basically paying to talk for advice, the better you are, because then you can go there and you can get some idea as to what the person is saying and whether they're on the right track or whether they're missing some key point or something like that might help. And a lot of the tools on the IRS probably aren't enough to stand on their own to feel comfortable or confident with tax preparation, but they're great tools to help supplement your information, take that information and bring it in to your tax preparation, whether it be by a third party or by some type of assistance with the Internal Revenue Service. In this presentation, we will consider the rules for an adopted child as it relates to the child tax credit. You can find this information on your resources within the 2018 instructions for Form 1040. The general rule is, of course, what we would expect, that the adopted child will generally qualify for the child tax credit in the same kind of conditions as would be the case for a natural born child. So let's go to the text, back to the text. Adopted child. An adopted child is always treated as your own child. An adopted child includes a child lawfully placed with you for legal adoption. So that, of course, will be the general rule, what I would think is like kind of the spirit of the law, that, of course, if something is a legitimate adoption, that you would have the same kind of characteristics for the calculations or what the child tax credit would be as with the natural born child. However, now we got to talk about the logistics of it, because, of course, as the IRS needs to be careful of kind of abuse and things like that with regard to the reporting of adopted child, and how do you do that information? We're going to have some kind of identification. How do we logistically process the paperwork related to the adopted child, and what kind of differences might there be from the naturally born child? So second item, back to the text, adoption taxpayer identification number, or ATINS. So we're going to have some kind of, obviously we need the identification number here. Back to the text, if you have a dependent who was placed with you for legal adoption and you don't know his or her SSN, Social Security number, we don't have the Social Security number, you must get an ATIN, Adoption Taxpayer Identification Number, for the dependent from the IRS. See Form W7A. You can find that by going to the irs.gov and searching for the Form W7A, so irs.gov for details. And there's probably going to be a form, and then you'll see basically instructions for the form typically, and some guidance from that point forward. So obviously, from a logistical standpoint, you can see the issue here, and that's going to be that we need to make sure that we have the Social Security number. We can tie this, not we, but the IRS needs to have an identification number. They need to assign the identification number to both the child and to the caretaker of the child, and then have the qualifications from there. If there's no social security number, some other type of number needs to be identified, and that's going to be the adoption taxpayer identification number. Back to the text. If the dependent isn't a U.S. citizen or resident alien, apply for an I-10, I-T-I-N, instead using Form W-7. And again, you want to look at the instructions for the Form W-7 on the irs.gov, irs.gov website to move forward from there. In this presentation, we will consider the rules for an adopted child as it relates to the child tax credit. You can find this information on your resources within the 2018 instructions for Form 1040. The general rule is, of course, what we would expect, that the adopted child will generally qualify for the child tax credit in the same kind of conditions as would be the case for a natural born child. So let's go to the text, back to the text. Adopted child. An adopted child is always treated as your own child. An adopted child includes a child lawfully placed with you for legal adoption. So that, of course, will be the general rule, what I would think is like kind of the spirit of the law, that, of course, if something is a legitimate adoption, that you would have the same kind of characteristics for the calculations or what the child tax credit would be as with the natural born child. However, now we got to talk about the logistics of it, because, of course, as the IRS needs to be careful of kind of abuse and things like that with regard to the reporting of adopted child, and how do you do that information? We're going to have some kind of identification. How do we logistically process the paperwork related to the adopted child, and what kind of differences might there be from the naturally born child? So second item, back to the text. Adoption taxpayer identification number, or ATINS. So we're going to have some kind of, obviously we need the identification number here. Back to the text. If you have a dependent who was placed with you for legal adoption and you don't know his or her SSN, Social Security number, we don't have the Social Security number, you must get an ATIN, ATIN, Adoption Taxpayer Identification Number, for the dependent from the IRS. See Form W7A. You can find that by going to the irs.gov and searching for the Form W7A, so irs.gov for details. And there's probably going to be a form, and then you'll see basically instructions for the form typically, and some guidance from that point forward. So obviously, from a logistical standpoint, you can see the issue here, and that's going to be that we need to make sure that we have the Social Security number. We can tie this, not we, but the IRS needs to have an identification number. They need to assign the identification number to both the child and to the caretaker of the child, and then have the qualifications from there. If there's no Social Security number, some other type of number needs to be identified, and that's going to be the adoption taxpayer identification number. Back to the text. If the dependent isn't a U.S. citizen or resident alien, apply for an I-10, I-T-I-N, instead using Form W-7. And again, you want to look at the instructions for the Form W-7 on the irs.gov, irs.gov website to move forward from there. In this presentation, we will consider the child tax credit in the event of divorced parents or separated parents. This is a common situation. We'll go over some general rules here, and if this is a situation you are looking at, then you probably, of course, want to get some advice as to the child tax credit and the relationship between it from a divorced parent situation. So, of course, our problem here, the issue here, is that if we have the child and we have two separate tax returns being filed, then what happens to that child tax credit? Now we have two returns, one child. We can't typically have basically the child tax credit for two different returns. The IRS doesn't like that, because then we would have the Social Security number of the child on two separate returns, basically two separate returns claiming the child as a dependent, and therefore also possibly taking the child tax credit with it. And the IRS doesn't let it, right? Only one Social Security number can be on each return. It's kind of like the general rule that you would have. You can't have the same Social Security, if the Internal Revenue Service, in other words, allowed the same Social Security number to be used on multiple returns in different situations, that could get messy real kind of quick. So the general rule is the database system within the Internal Revenue Service, anytime it sees basically two numbers claiming to be the same person, will typically kind of spit that out. So now the question is, well, what do we do in that situation where we have divorced individuals, two separate tax returns, and two people that could potentially claim a child tax credit or the dependent, how do we deal with those situations? And again, if you're in that situation, you do want to get some advice on how to go forward with that. Therefore, from a logistical standpoint, you know what's going to happen from the IRS's standpoint. If you have one dependent being claimed, and whether it have a child tax credit or not, it's most likely that if it's only one social security number that's being claimed, the IRS may process that just from a logistical standpoint, process that and say one social security number, and it's more likely not to have basically an issue for it. However, if two individuals, two tax preparers, say a divorced husband and wife or a divorced couple, file a tax return with the same social security number for the one child, then it's one of those things that it's not likely to be, it's very likely that the IRS will question that. Why? Because the system can easily automatically do that. They don't need to basically pick a return. So they could automatically see, the system will just automatically say, hey, there's two social security numbers, two returns claiming the same social security number. So from a logistical standpoint, note that if the two individuals have a return that are using the same social security number as a dependent and or for the claiming of a child tax credit, it's very likely, more likely than in other types of issues, that the IRS will give some type of letter. And of course, some type of letter indicating some type of audit or review or questioning. And of course, the letter is going to be indicating that there's a problem with the one social security number on two different returns. So if you know that's the case, you can expect that basically there's going to be some type of letter that will be given. And just note from a logistical standpoint that, you know, the first tax return that goes out, that's going to be the first social security number, the first tax return that claims the social security number, and therefore the second person that sends their taxes in, the later person that sends their taxes in, that's going to be the one that triggers the IRS's system most likely to say, hey, we've already got that social security number into the system. So just note that when the letter goes out there, it's likely to go to the second person who gave the tax return and say, hey, the social security number has already been claimed. Here's the adjustment based on this. And that doesn't mean it's right or not. That doesn't mean the first person's right in claiming the social security number possibly, and doesn't mean you can't go forward and get advice from that and whatnot. But just notice that from a logistical standpoint, that's what's probably going to happen. The IRS is going to say, all right, here's one person that gave us a social security number. That doesn't look unusual or anything. And then, oh, here's another person that had the same social security number. That looks funny. We're going to probably send a letter to that second person saying, hey, well, this number's already been taken. And then it goes from there. Then you can basically think about how, if that's the logistical way it happens, then the question is, well, how do I go from there and talk to the IRS from that point and go into the rules for it? Obviously, what you want to do most of the time is to figure those rules out before the case, if at all possible, between the individuals that could possibly claim the dependent, and make sure that the agreement is clear and everything is clear. This is going to be just a kind of a starting point. This is on the instructions for the Form 1040. You can start there, take a look at it from there. It'll be included in your resources as well. Let's get back to the text. Children of divorced or separated parents. A child would be treated as a qualified child or qualifying relative of his or her non-custodial parent, defined later, if all the following conditions apply. Note we're looking here at the deviation from the norm, because normally we would think that the child would qualify for the child tax credit for the custodial parent, and we're looking at those conditions where that may not be the case from certain conditions to conditions, and that would be when we have the non-custodial parent. So we'll get into the rules of what is the custodial parent, what is the non-custodial parent, and then need to consider the rules in terms of when it might be possible to have the exception of moving from not being treated as the custodial parent, the traditional parent you would think that would be claiming the dependent and the child tax credit, to a situation where it might be the non-custodial parent. And you might consider, when would this apply, or why would someone want this to apply? And if you think about basically a divorce situation, there's a couple things that the dependent will affect, and that's going to be something like the status. So if we're single, we would rather have the head of household status, and we know that the child or the dependent can affect that. And of course, the child or dependent can affect the child tax credit as well. And they have different consequences. So obviously, if we have two individuals that have different amounts of revenue, income, then they have different amounts of taxes. And the question with the divorce might be in terms of how can we lower taxes overall, and how can we lower taxes for individuals, one individual, another individual. And so those are two kind of separate issues. And if, for example, if you have the head of household status, then that might more benefit the person, whichever of the two have the higher income, because the head of household might result in lower tax brackets, and therefore to claim as a dependent might help in that situation. However, if the income is really high for one spouse versus another, then they might completely lose the child tax credit because of income, the income threshold. So in that kind of situation, you can see through a divorce agreement that they might be trying to think about, well, how can we get the best of both to benefit both people as well? And that would mean, well, we want to be able to claim the dependent in such a way that we get to take advantage of the tax brackets and possibly claim the credit. It'd be nice if we can claim the credit in such a way that we still get it, which means it'd be nice if we can put the credit to possibly the lower income individual that could still maximize the credit, which it would phase out for the higher income, and maybe have the higher income individual be able to claim the dependent in a situation that would lower the overall taxes between the two because they have the higher income. So you can see how this gets a little bit complicated. The incentives when you're doing the tax planning could be a little confusing to think through as you go through that agreement. And again, things to consider just when you go through the actual agreement. Text number 1. The parents are divorced, legally separated under a written separation agreement, or lived apart at all times during the last 6 months of 2018, whether or not they are or were married. So that's condition number 1. Number 2, back to the text. The child received over half his or her support for 2018, the taxable year, from the parents, and the rules on multiple support agreement later don't apply. Support of a child received from a parent's spouse is treated as provided by the parent. Number 3, the child is in custody of one or both of the parents for more than half of 2018. So you'll remember that we had that kind of custody issue, and we said that basically to be a qualified child, they have to be in the particular household. Well, one of the common divorce kind of agreements would be that there's some kind of splitting of how often would the child live. So now if the child lives basically half and half, if we say it's exactly half and half, then there's a question with regard to that kind of that requirement that they live in a particular home for more than a half to qualify for the child tax credit. So number 3 here, the child is in custody of one or both of the parents for more than half of 2018. Number 4, either of the following applies. For A, the custodial parent signs Form 8332, or a substantially similar statement that he or she won't claim the child as a dependent for 2018. Now you can find that form on the IRS website. So if you go to irs.gov and look up Form 8332, you'll see it's called Revocation of Release of Claim to Exemption for Child by Custodial Parent. And then B, a pre-1985 decree of divorce or separate maintenance or written separation agreement between the parents provides that the non-custodial parent can claim the child as a dependent, and the non-custodial parent provides at least $600 for support of the child during 2018. So note we have a support dollar amount here as well. So that's obviously a fairly low dollar amount. So back to the text. If conditions 1 through 4 apply, only the non-custodial parent can claim the child for purposes of the child tax credit and credit for other dependents, line 12A and 17B. However, this doesn't allow the non-custodial parent to claim head of household filing status, the credit for child and dependent care expenses, the exclusion for dependent care benefits, the earned income credit, or the health coverage tax credit. The custodial parent or another taxpayer, if eligible, can claim the child for the earned income credit and these other benefits. See publication 503 for details. Back to the text. Custodial and non-custodial parents. The custodial parent is the parent with whom the child lived for the greater number of the nights in 2018. So custodial parent, notice how they're defining it there. The definition of the custodial parent is the one that they lived there for the greater number of nights. Again, a lot of divorce agreements basically might cut that 50-50 in terms of the divorce agreement. The text, the non-custodial parent is the other parent. If the child was with each parent for an equal number of nights, the custodial parent is the parent with the higher adjusted gross income. Now you might think that's funny. Why would the custodial parent be the one with the higher adjusted gross income? If they, in other words, condition number one, custodial parent is going to be the one that the child spends the most time with. That makes sense as the first condition. But then condition number two, the one that has the higher adjusted gross income. And the thing there is, I mean, I'm just guessing on trying to interpret the law here, but if you have basically two people where the child was in the same place the same amount of time in both areas, then the idea would be the person with a higher adjusted gross income under those circumstances might be the one more likely to be providing basically more of the support, or at least the financial support. So if there's an equal number of hours of our support there, and then you go to default 2, which is the income, higher income more likely given by this law, that's my interpretation of it, to be someone giving more support. So in any case, those are the two conditions. Back to the text. See publication 501 for an exception for parents who work at night. You know, that's a bit of a, you know, if one parent works at night and they still spend all the days there, that would be kind of a funny rule. So that might be an exception if you work nights, and that's one of the rules. There's actually an exception directly specific to that, and so you can look that up. Pub 501 rules for a child who is emancipated under state law and other details. Post-1984 and pre-2009 decree and agreement. The decree or agreement must state all three of the following. 1. The non-custodial parent can claim the child as a dependent without regard to any condition such as payment of support. 2. The other parent won't claim the child as a dependent. And 3. The years for which the claim is released. The non-custodial parent must include all the following pages from the decree and agreement: cover page, including the other parent's social security number, SSN, on that page, the pages that include all the information identified in 1 through 3 above, signature page with the other parent's signature and date of agreement. In this presentation, we will discuss the issue of a qualifying child of more than one person concerning the child tax credit. This information can be found in the 2018 instruction for Form 1040. Back to the text. Qualifying child of more than one person. Even if a child meets the conditions to be a qualifying child of more than one person, only one person can claim the child as a qualifying child for all the following tax benefits, unless the special rule for children of divorced or separated parents described earlier applies. So we're thinking about that rule again, this issue of we have the one child here. What's the case in which we have two people that can claim the qualifying child? In other words, if we have this condition met of the child being a qualifying child for more than one person, and therefore possibly we would think then be able to be reported and get the benefits of that qualifying child for tax purposes on more than one tax return, that's typically not the case. We can only put the qualifying child on one tax return, typically, and note that there is this exception to the general rule, which could apply that we talked about briefly in the prior presentation in the case of a divorced or separated parents. So the general rule then is going to be that if we have a child that can be claimed as a dependent and or a qualifying child for a tax credit, then they can typically only be those things on one return, and typically we can only have one social security number on one return, unless there's some kind of condition, some type of special condition that is present. Now we're going to list the tax benefits that this applies to. So number 1, back to the text, child tax credit and credit for other dependents and additional child tax credit. That's of course what we're focusing in on here. Number 2, head of household filing. Note this is another kind of benefit of having possibly a child is that it may help you, taxpayer, to qualify for head of household rather than single filing. And what that's going to do, obviously the child tax credit could be a $2,000 credit. The head of household rather than single filing could allow that taxpayer to then have lower tax brackets and other types of benefits from the not being filing as single but head of household. So then we have number 3, credit for child and dependent care expenses. So if there's going to be a credit for dependent care expenses, caretaking, that's another type of benefit that could be there, or at least we can think of it as a reimbursement type of benefit or something like that. If there was payment for child care, then you might be able to get a credit for that. And then number 4, exclusion for dependent care benefits. Number 5, earned income credit. So these are another kind of benefits that could be there from a child. Earned income benefit is another kind of big one that could result in a refund even if no tax is owed, and it's heavily influenced by whether or not there's a child involved. So note that when we think about these items with relation to a child being on one tax return or another tax return, when we consider the overall tax benefits, it can be a little bit confusing to think about because, again, the earned income credit probably could help somebody if there's a low income, and won't help anybody to have a child or no child. It's not going to give any more tax benefit on an earned income credit if their income is high. So if you're talking about two taxpayers who have very different incomes, high versus low, then the child being on one return could have this benefit here, whereas the child on the other return wouldn't have any effect. The same could be true for a child tax credit. If one income is really high, then they might not benefit at all from the child tax credit, whereas the other could. The head of household is kind of the reverse oftentimes, because if someone makes more money, if one spouse makes more money than the other, then there's going to be overall tax savings. Probably it's going to be more leaning towards the person who has a head of household type of status, because that means you're going to apply lower rates to more income typically. So note, when we consider, well, just from just a tax standpoint, nothing else, who would benefit from having a child on a certain tax return, it can get a bit confusing. Of course, if there's multiple children, then it can be a little bit confusing as well. So, and note that the general rule is that all these things, if one child is on one tax return, they could qualify one tax return for these things if it benefits or not. And we can't normally have a child that could be basically claimed on two tax returns for different type of things. So we couldn't normally say we're going to have the child on one tax return for helping out with head of household, because that would be the best tax benefit, and on another tax return with regard to the earned income credit or something like that. That's not normally the case unless there's some kind of unusual circumstance. Normally, we can only have one social security number on one tax return per person. If it's a dependent, then typically we have one dependent tax return social security number on one of the two returns, again, unless something kind of unusual is going on. Back to the text. No other person can take any of the 5 tax benefits just listed based on the qualifying child. If you and any other person can claim the child as a qualifying child, the following rules apply. Number 1, or first rule, back to the text. If only one of the persons is the child's parent, the child is treated as the qualified child of the parent. So, for example, if you had a situation maybe that the child was a qualifying child for two people, one was a parent and one possibly a grandparent or something like that, then the tiebreaker then would basically go to the parent then. So if they meet all the requirements for a qualifying child for two people, then the question is, well, who is the qualifying child for, or which person then can claim the child as the qualifying child in that case? And it would typically, of course, go to the parent first. That would be kind of like the tiebreaker. Back to the text. If the parents file a joint return together and claim the child as a qualifying child, the child is treated as the child of the parents. So obviously, if you have a qualifying child that is in a married two parents and possibly could be a qualifying child or meets all the tests somewhere else, then obviously the two parents that are filing joint would be the ones that would be claiming, or the qualifying child would be on or for the parents rather than someone else that might be qualified for it. Back to the text. If the parents don't file a joint return together, but both parents claim the child as a qualifying child, the IRS will treat the child as a qualifying child of the parent with whom the child lived for the longer period of time in 2018. If the child lived with each parent for the same amount of time, the IRS will treat the child as a qualifying child of the parent who had the higher adjusted gross income, AGI, for 2018, the taxable year. And this is going to be kind of like the general default rule, right? And the general kind of default situation. If you have the two parents are filing separate returns and they both claim the child as a qualifying child, well, then, of course, now the IRS has that situation. They're going to say, well, now I have the Social Security number for one child or one person, and it could be one person has their Social Security number on two tax returns, and someone's getting benefits for that. And then the question for the IRS is, well, how are we going to deal with that? And the default will typically be the parent who had the longer period that they lived with. So it's typically going to default to the living, which one had more basically kind of control or custody in terms of the living of the child. So if the child lived with one parent more than the other parent, that would be usually typically the tiebreaker. Now, again, a lot of times, at least in the divorce agreement, there's kind of a 50-50 split a lot of the time. And if that's the case, if it's even between the two, then it goes to the parent with the higher adjusted gross income. And again, that's just what the law said. That's what's in the rules here. If you want to know justification, I would assume the justification for that is that it's assumed that the higher adjusted gross income is going to be the person that is providing more support. So if the living conditions are 50-50, then the IRS leans towards the higher adjusted gross income, thinking that that's probably where more of the actual support comes from. So that's why that it would be the tiebreaker. So again, you can look to special rules for other type of divorce type of agreements, but this is kind of like the default tip. And again, for more information on these types of things, you could start by looking at the instructions, 2018-1040 instructions, and basically get some idea, go from there, and then get some advice if you need to in those types of situations. Back to the text. If no parent can claim the child as a qualifying child, the child is treated as a qualifying child of the person who had the highest AGI for 2018. So now you're thinking of a condition, well, what if the child doesn't meet any of the tests, right? Well, in that case, the child doesn't file their own tax return because they don't have any income. So what happens then? If they don't meet all the tests for anybody, then who claims the child? Because obviously the Social Security number should basically go somewhere. The child's Social Security, they should be claimed somewhere. So if the tests aren't met, then the IRS is basically saying that someone still should be claiming the child and getting the benefit of claiming the child on the tax return. And they're going to say that's going to go to the parent with the highest AGI. So again, the more normal kind of circumstance would probably be that you have two people that are saying, hey, the child qualifies under, I've looked at the code, that's a qualifying child for two people. In that condition, well, you'd say, oh, right, well, is one of them the parent? Because usually the parent would then win out. And that would be the case. Well, what if both of them are qualifying child and they're both parents and they file separate tax return? Well, then it would typically be the case of the person that the child lives with the longest. That would usually be the tie-breaking rule according to the typical type of law. Okay, well, what about the situation where where they lived equally under the two parents, and the kid qualifies under the rules for both parents? Well, then it's usually the one with the higher AGI. And then you got the situation, well, what if neither parent qualifies because they didn't spend half the year possibly or some other condition with either parent? Maybe they spent a couple months with multiple different people and aunts and uncles, and they've been all over the place for this year or something like that, and they don't qualify for a qualifying child for anybody. Well, then the IRS will still give the benefit to somebody for claiming the child, and that'll typically go to, by default, the one, if it comes down to the rules here, the one with the highest adjusted gross income. Because again, the presumption by the IRS would be that they're the one that might be providing more support, and they probably are the one that might benefit most depending on the conditions of the divorce. Now we'll talk about, and we'll do some testing about who would benefit most later, because it becomes very strange. Like if you're unmarried and you're thinking about getting married, are there benefit? I mean, is there a tax benefit, or is there a way that sometimes you can actually lose out? And when you think about things like a child tax credit, and you think about things like an earned income credit, it could be possible. And when you see a divorce type of situation, then again, the question is, well, what happens in terms of, are people better off or worse off for taxes, and how does that come into play? And it gets kind of distorted, especially when you're in the range of someone being in the low income side, because then you have those things. Well, it could get distorted on either side, but because the high income, you're looking at tax bracket differences in the amount of money. The low income, you got weird things going on with these tax credits that could result in fairly substantial refunds, like the earned income credit and the child tax credit. Back to the text. If a parent can claim the child as a qualifying child, but no parent does so claim the child is treated as a qualifying child of the person who had the highest AGI for 2018, but only if that parent's AGI is higher than the highest AGI of any parent of the child who can claim the child. Again, an unusual type of situation here. We're saying now in the case that no one claimed the child, but it's possible that the parent could have claimed the child. So then, again, the IRS is going to have to say, well, they've got to kind of belong to somebody in that case, or what would be the default position in terms of taxes, or what would be the tax return they'd be on. And it would go to the person with the highest AGI, and that might be someone that's not the parent in this case, because the parents didn't claim, but only if the person's AGI, the one that's not the parent, like a grandparent or something like that, is higher than the highest AGI of any parent of the child who can claim the child. So if the parents don't claim the child and they have an AGI that's higher than another person that could qualify, then it would go to the parent. But if that's not the case, they don't claim the child and someone else's AGI is higher, then that would be the case. Now again, unusual circumstance, because that would mean that no one claimed the child, which is kind of unusual. Back to the text. Example. Your daughter meets the conditions of a qualifying child for both you and your mother. So now this is the daughter of you and your mother. So you would think there'd be the child being your child. If this was our child, then you would think the default would typically go to the parent here over the mother, even if they were qualified. Let's go on and see what happens. Your daughter doesn't meet the conditions to be a qualified child of any other person, including her other parent. So the other parent's out of it. Under the rules just described, you can claim your daughter as a qualifying child for all the 5 tax benefits just listed for which you otherwise qualify. Your mother can't claim any of those 5 tax benefits based on your daughter. However, if your mother's AGI is higher than yours and you do not claim the daughter as a qualifying child, your daughter is the qualifying child of your mother. So again, in that situation, of course, you would think the daughter would basically claim the qualifying child, but if she doesn't, and maybe this is strategic, maybe she would strategically, for some reason, because of tax benefits, decide not to claim the qualifying child. I don't know why. I won't get into the weeds on that. But in that case, if that were the case, then how the mother, if her mother's AGI was higher, then you do not claim the daughter as your daughter is a qualifying child of the mother. And you can imagine a situation, well, would you ever want that to happen? Well, maybe. I mean, maybe if the mother's AGI is higher, then maybe there would be a tax benefit. And again, we'll get into some scenarios when there would be or wouldn't be. It's kind of tough to say, because the lower tax side, again, the child could qualify for an earned income credit and a child tax credit, or help to qualify for those things. On the high income side, it could help with claiming for a head of household. So it's tough to say, or it gets a little confusing to know which would be better, higher income or lower income. We'll talk a little bit about that with some examples next time. Again, this is just an introduction, so you want to go from here if this applies to you and do some research on this. For more details and examples, you can start at publication 501. In this presentation, we will use tax software to run some scenarios related to the child tax credit. We're going to take the situation of either 2 individuals getting married or 2 individuals getting divorced and think about the tax consequences of having 2 people that have separate tax returns coming together. What's the tax consequence? What's the tax consequence of having 1 tax return filed by 2 people married who then get divorced and then have the 2 tax return? Paying special attention to the child tax credit. Note that this isn't tax advice. There's many different scenarios. We're just going to use the tax software to get some ideas of the kinds of things that will be adjusted and changed in these situations. Here we are in our test 1040. We're going to start off this time with a married filing joint. And remember, what's going to happen is we're going to go from married, one tax return to two tax returns. And you can think of this as going the other way too, right? Of course, if we were two people that had two separate tax returns and we got married, same kind of thing. So you have the same kind of tax thinking that you need to go through from a tax standpoint, at least. When you're thinking about getting married, what's going to be the tax consequence? What's going to be the tax consequence if you were to get divorced, and what are the types of things that could change there? So they have some similarities in that way. So we're going to start here as if we have the two individuals getting married in our mock return. So we have the Smiths here, mock address, and we're going to say that there's one dependent. So we'll start off with the one dependent, and we're concentrating here on the child tax credit. We're going to start off with an even split of income. So we're going to say they both earn $50,000, but for married, doesn't matter who earns it. We're just going to say there's $100,000 of income for the one tax return of the married couple. And that means that there's a standard deduction of the $24,000. So we're just going to take the standard. We're not getting into any complications of the itemized deductions. We're just taking a straight standard deduction here. And that gives us the $76,000 of the taxable income. The tax then calculated at $8,742. And we then have the child tax credit, where what we are focusing in on here, the $2,000 for the one child. I'm going to then put this into our little worksheet so we can follow along with this. So this is going to be the married. So when they're married, we're going to say that the total for the married will be that they have $100,000. The child tax credit's worth the $2,000. There's no earned income credit, but that's the other thing we got to watch out for. So we're just going to let the tax software, calculate that. And then we've got the tax here. So the tax is currently 7642. Now we're going to say, well, what happens if they split up? Or you can think of it again the other way. What if we had these two people that earned $50,000 and they got married? Now we're going to say, okay, well, there's only one child, so we're going to have to apply that child to one or the other. And again, you could think of this situation as if you are single and you're thinking about getting married and you have one child, or you don't have one child, or vice versa. Now I'm going to say the child is starting here. The child tax credit will go here to the wife, I'm going to say. And again, I'm just trying to keep this straight in my head. Obviously, we can have a ton of different scenarios. So I'm just picking these scenarios to try to keep them all straight in my head. So we're going to say that the child is going to be with the wife then when they separate. And therefore, the child tax credit will go here. And what are going to be the tax consequences of that? Well, now we had one return before. Now we have two different returns and only one child. And the child, we're going to say, is on the wife's return. So let's see what happens then. So if we go back to our scenario, we're going to say, all right, let's make the changes there. The changes that are going to happen then is we're going to have one dependent that is going to be claiming the dependent. So the dependent is still there, and we're going to say that's going to be on one return, but the return is going to be now, instead of single, it would be married or head of household for the person who was able to get the child as a dependent, most likely, because that's usually the thing that takes you from single to head of household. I'm going to start here with single, however, because I just want to show that that's basically what the tax code or the law is kind of basing it on. So let me explain here. I'm going to pretend single, even though probably head of household status would be achieved, and that would be beneficial if that dependent was with that child, was with that individual. So, but let's keep it single here just for example purposes, to split it evenly. Okay, so we're going to say single, and we're going to say that the wages then for the one individual are split evenly, $50,000. And again, we'll look at different scenarios for that later, but we're going to say, all right, if we go to our forms then, we're going to say that it would have a single. Again, that could be head of household if we had this dependent, but we're going to say the dependent is here, and for whatever reason, it's going to be single for now. And then we have the child tax credit there. There's the $50,000. Now, of course, the standard deduction is now only $12,000 because now we have a single return. And then the tax then being calculated is $4,373. There's the $4,373 minus the credit, leaves us with $2,373. So that's going to be the one individual who gets the child. And again, it doesn't matter which one does, but we're going to say one gets the child, and therefore that's going to be the tax consequent of it. We'll talk about the head of household status later. So we'll put that into our worksheet. 50,000 for the wife. We're going to say that there's 2,000 of the child tax credit there, no earned income credit at this time, and then the tax is 2,373. Okay, what about the other side? We're going to say, well, the other side, if we go back, we're going to say is split evenly, so the income is still 50,000. The dependent, however, is not going to be there, so we're going to take the dependent off, and the other spouse or ex-spouse is going to have then single status, and I have two dependents now. No dependents. And then if we then look at what we have the 50,000 and then the 12,000 standard deduction still, and that gives us the income or the tax of 4,373, but there's no credit. We don't have the 2,000, of course. So now we have the 4,373 of tax on the other spouse. So therefore, if we split this up, then we still have the 100,000. If we add this up, 100,000 of total income, the child tax credit in total is 2,000 between the two returns. That makes sense. No earned income credit. And then we have the total tax then split unevenly. So one spouse 4,373, the other 2,373, but the total comes out to be what you would kind of expect, pretty much in the range. It's almost the same. So if we took the differences then, of course, the wages are the same. There's no difference in the total in terms of the child tax credit. No difference there, as well as the earned income. There is no earned income credit. And then the tax is within a couple dollars. And that's why I want to show this first, because that's probably what the IRS is thinking. They're saying, hey, if you're married and then if you get married, then we don't want people to have any kind of difference between married or not married. But of course, that's impossible to kind of do because it gets complicated. And the reason that this isn't quite right is because one of these, the one that has the child, is probably going to have a benefit in terms of the tax credit, but also going to have a benefit for the filing status. So let's change that now and see what that is. This one is probably going to be a little better because the filing status will be there too. So that's going to be our next scenario. So let's say, all right, we have the same thing. Here, everything's the same, except that now we're going to change this item and say the credit's still there, but the total tax will probably change because we're going to change the filing status. So let's do that now. We're going to say, all right, well, let's put the dependent back on the books. We've got 50,000 of wages. And now we're going to say the other thing that probably will change because of that dependent is the head of household. Now we have a head of household status rather than single. And that's beneficial typically. And oftentimes the child will make someone qualify for head of household. So now we're head of household rather than single for the one individual. I know I'm keeping the same name, but the split, I'm just talking one spouse and another spouse, spouse 1 and 2. So we're going to say, all right, so now that we have the dependents on the books, we have the 50,000, and the only change now is that there's a head of household status. So we then have the standard deduction at 18,000 rather than the 12,000 for head of household, which is a benefit. And typically the tax rates could be a benefit as well. So now that's going to give us the taxable income of the 32 and the tax 3,571. And so that minus the 2,000 gives us the 1,571. So if we put that in our worksheet, and again, these are just numbers, I'm just testing numbers with the tax software, so this isn't tax advice. I'm just zeroing in on some items you may want to look at as you consider either getting married or a separation, as you think about those things. So we've got now here, the difference being this tax, of course, is changed because of the head of household status versus what we had before, single versus head of household. And so now you've got something that's a little bit different. The wages before when married are the same as after married. The total child tax credit is the same, no change there. But now there's a change to the taxes. Here's what the taxes were before, and now actually the taxes are less when you're separated, which again, this is kind of unusual because you can think of two people thinking about getting married and the tax consequence is actually a little bit worse possibly sometimes because of things like this. And the child tax credit is one of the things that happens with. I mean, it's possible that the total tax could be less if you're not married because of things like the kind of weirdness of child tax credit and the filing status between head of household and single. And of course, then you can see the disparity between the individual. So the two things you're trying to look at here, of course, is, okay, if I'm getting married or getting separated, what's going to be the difference between the two and how can we make our agreement account, for that, make it fair and transparent. And of course, the total, you're considering the total. We want the total tax. I mean, the last thing we want is to give more money to the government, right? So you want the total to be down as low as possible. And then, of course, think about how to split up between yourselves the disparity of what that would be the ideal situation. Do whatever you can do within the law to get the total tax as low as possible, and then agree amongst yourselves to split that in whatever way is fair. That would be the kind of way to think about it either way. So now let's think of another scenario. This time we're going to have the 100,000 split evenly between the two. So they're married. We're going to start off married again, and they'll split evenly here. But now there's going to be 2 children, which would result in a credit of 4,000. So let's consider that situation. If we start off, then we're going to say, all right, now we've got married again, married status, 2 dependents, and they both qualify. They're both children that qualify for the child tax credit. Okay. Well, then we've got the 100,000. We've got the 24,000 of the married filing joint now. That gives us the taxable income of the 76,000, tax now at 8742. Then we have the 2 now, the child tax credit for the 2 children, 2,000 each, maximum credit, 2,000 per child, 4,000, bringing the tax down to 4742. So we're going to bring this to 4742. Now we'll say, okay, what if there's a split and we split this evenly with the child, each person taking a child, right? In terms of the tax return. And again, I know, in real life, like, what does that mean in terms of okay, we're just putting them in the tax return here. So we're going to say, okay, well, what if they each have a child? Now we're going to say that that'll be split evenly, and they'll both probably get head of household status from single to head of household. So now they're going to be single, or you could think of single then getting married. If 2 persons were single and then get married, they're probably having head of household before, and now they're going to get married, which means they're going to have, that would be married status. You can think of it either way. So now we're going to go here and we'll say, all right, so now we'll go back and say that we're going to change the status. And again, this would be the same for each. So I'm just going to do one return here, obviously. Single, and we'll say dependents. Now they each have 1. Actually, not single. It's going to be head of household. And that's the benefit here. If we have the 2, we're going to say head of household. They're both going to have 1. Both qualify for head of household. So everything's split down the middle here with the 2 kids. And then the wages are going to be 50,000 each. Wages 50,000 each. All right, let's see what happens. According to the software, we're going to say that now there's head of household rather than single because of, or one condition oftentimes is the dependent for both now. And again, I'm only looking at 1 return, but for both now. And so if we scroll down, then we'd say that there'd be 2 returns that are pretty much the same at this point. We're saying, okay, 50,000 minus the 18,000 standard deduction, which is higher than the 12,000 now because of the head of household status rather than the single status. And that brings the taxable to 32,000, the tax at 3,571. And then here's going to be the credit of 2,000 that they each have to have the amount of 1,571. So if we were to put those numbers in our worksheet, now we had before, this was our tax, and we had the child tax credit. The child tax credit split evenly now. So everything's split evenly between the 2 spouses, whether we would be having this situation then get married or having a married situation and being divorced. It would go from 2 to 1, 1 to 2 in terms of the number of tax returns. Same total income, 4,000 total credits the same, and it's split evenly because, of course, now we have the 2 children applied out evenly. And then the tax then would be even if everything was completely the same. And then the total tax would be 3,142. And you'll note that the total tax then is actually better under the separated rather than married, and that's because of basically the filing statuses of single to head of household. You'll note when they're married, it's kind of like it seems like the tax code basically doubled single status to married, and that head of household, if there's a head of household status, means that being separated, or that's one of the factors. And these credits and the child tax and the earned income can be kind of funny to make it so that so that when you're not married, it could actually have a tax benefit. So, again, we're just putting numbers in, just a couple scenarios, just some things to think about. But so you want to make sure to have your own kind of scenario when you think about getting married or just the tax consequences. But here we go. Let's do another scenario here. This time we'll start at the same place. So we've got the 100,000, we've got the 4,000, and the tax at 4,742. But now we'll say, what if one of the spouses take the full 4,000? Both children claim both children. In that case, we'll say the husband this time. So we'll say one of the spouses takes the two children, and the other spouse has no children and has the even amount of income. Well, what would happen there? Now we got to say, well, the husband or this spouse would get the filing status of head of household, where this one would not, and you have that 4,000 potential for the credits. So let's see what that would look like. So we're going to say, all right. So now if we go back here, now we have one individual, one of the spouses that are now separate returns now, and it's a head of household status because now the two dependents are on one return, one of the two now. So a head of household rather than single. And then if we say, okay, there's 50,000 of income, we have the 18,000 of the standard deduction because of that head of household status. And that brings us to 32,000, the tax 3,571. And so the tax is 3,571. And of course the credit is going to be limited to the tax there. But then also there's a refund. So notice that the credit is 3,571 plus the 429 or the 4,000. And so now, even though no tax is owed after the credit, then they're getting money back. So that means that one person would actually not pay any taxes and get money back. Not owing any tax, but get money. Okay, so what about the other side of things? And again, this has nothing to do with payments because the payment, they could have already paid it. They may have not have already paid it. That's not what we're looking at here. We're just looking at how much was owed. In this case, nothing was owed and money was gotten back, whether the payments were made or not. So, okay, so we're going to go back and say, all right, well, what about the other? We'll say the other is going to have a status of single, not head of household, because typically they can't unless they have a child. And so we're going to say, all right, and then the dependents, not going to have any dependent. So that these will be removed. And then the wages is still going to be the 50. So we'll say, all right, what about the other? Is at single status, and again the name's the same, one spouse, the other spouse under these two situations. Then we're going to say 50,000 minus the 12,000 standard deduction gives us the 38,000 income. Taxable, the tax is 4,373. No, we have no credit, so the tax then is that 4,373. So we notice here then there's a kind of a huge disparity, right? If they were married under this condition, then you'd have the 4,742. The total is of the two tax returns isn't too far different. And I'm just putting this into the software. There could be a lot of other kind of factors. We're just looking at these factors. But note the difference between these two, of course, the spouses. This individual got a $4,000 credit on it, and the tax is now at the 429, actually a refund. Whereas this individual who had the same amount of earnings is paying tax 4,373. So this person isn't paying any tax, is actually getting money of 429, and this person is paying tax 4,373. So if you subtract those two out, then that would be kind of the net tax. And so this would be the difference basically overall under that scenario. Now these are all just scenarios if the income's basically the same and we have a very kind of simple return. And so we could think about, well, what if, the income wasn't? Obviously, most of the time, someone's doing more of the caretaking and someone is doing more of the working a lot of times. And therefore, if someone was to split up or get married, then it's likely that the income wouldn't be evenly dispersed between the two. They'd be making different amounts of income. What then? We'll take a look at a couple of scenarios next time. This presentation, we will use tax software to run some scenarios related to the child tax credit related to two individuals getting married and or two individuals getting divorced and the effect on the tax returns as we go from two tax returns to one or one tax return to two, focusing in on the effects of the child tax credit in the case where we have uneven income. In other words, two people have uneven income and then get married, or two people have uneven income and get divorced. What happens with relation to the child tax credits in those situations? We'll run some scenarios. This isn't tax advice. We're just using tax software and looking at a few things that will change and focusing in on those as given by the calculations for the tax. We're going to start off with a situation of a married couple, and then we're going to move to separating the two. And remember, it doesn't, either way it goes, we're going to go from one tax return to two. You could think of the same thing if you're in a situation with two tax returns and go into one. what are the tax consequences of basically getting married or getting divorced. So we got the married here. We have the 2 individuals as our mock tax return. We have the 1 dependent. We're going to start off with the 1 dependent at this time. We're going to say that we have the 100,000 of income between the 2, and it's all on 1 return. So it doesn't matter who earns it because we're just 1 entity for taxes here. So then that's going to be the 24,000 in terms of the standard deduction. We're not going to get into itemized, keeping it simple. We're going to say a taxable income is 76,000. The tax is then 8,742. So 8,742 minus the child tax credit 2,000 means the total tax is 6,742. Here is that information summarized on our worksheet. So 100,000 income, child tax credits, 2,000 tax, 6,742. Now, if we break out and we say, and I'm just breaking out between the 2 spouses, husband and wife, I'm going to say husband just to keep it straight in my mind, 80 versus 20. Now, what if they separate, or what if we were separated before and then got married or something like that, and there's a breakout of 80 versus 20 on the income? What's going to be the tax differences in total and between the 2, focusing in on the child tax credit? We've got the 1 child here. So let's first think about, okay, what if that child was then claimed by the person with the 80? So we'll say 80,000 gets the child tax credit or claims the child. Probably going to help with the filing status from single to head of household and have the child tax credit. And then we're going to say 0 here, and that'll say, all right, so the total is going to be the same for that 1 child. Let's take a look at that scenario first. So we'll say, all right, so if we go back to the income, we're now going to say income for 1 is 80,000, and they have the child. So the child's on the books. Their filing status is going to go from is not single, but head of household, given the child probably would help to put on head of household. So now we've got head of household rather than single. Again, we're just going to have the same individual. Like we're just going to change the same return. And so here's the dependent. We have the dependent qualifying for head of household typically, and there's the 80,000 minus the standard deduction 18,000, giving us a taxable income of 62. The tax is going to be the 8194, plus you got that tax credit to bring the tax down now to 6194. Here it is in our worksheet. So the 80,000 child tax credits on this side, and this is the way you might think to break it out, because you'd say, hey, well, I would want the child to be on the higher income tax return because it might have more of a benefit, and that's the first thing you might think. So we'll do both of these scenarios to see what would happen if the child was on one or the other side of a disproportionate income from the 2 tax returns versus the 1. So now let's go to the other side and say, all right, well, what would happen to the other tax return? We're going to, with the second tax return, then we're going to say that they're single status, not head of household, and again, the name's we're just going to keep the same name and use the same tax return. And then we're going to scroll down and say, all right, now there's 20,000. The exemption is only 12,000 rather than the head of household 18,000. Then we have the income of 8,000 and the taxable income, and that gives us the tax of 803. And then we don't have the child tax credit. And also note that the dependent is also something that may qualify. We're not concentrated on the earned income credit here, but just note that the child may be something that can affect that one as well. So if we look at this scenario, then we're going to say, all right, so it went from the total tax of 6,742 to, if there were 2 separate returns, of 6,997. So it's fairly close between the 2. The 1 individual is getting the child tax credit and getting benefit from the filing status as the head of household filing status there. Now, you would think that this would be the strategy that would work from an overall standpoint, not the breaking out between the 2. Again, you can look between the 2 here. There's a big disparity between the 2, but you would think from an overall standpoint that this would be the best way to go, because that would mean that the tax on the higher earnings would be taxed less, you would think, because it could possibly affect the tax brackets in that way. But if we had the child over here, it would not only move the credit over here, but it could affect the earned income tax credit, which could distort even the total tax kind of calculation on things as well. So remember, our goal kind of is, it would be ideal to get the total tax as low as possible and then work out our agreement. So pay as least as possible to the IRS, to the government, and then break out the difference in a way that is fair as possible. That would be kind of the ideal. So let's run this scenario and see it the other way. So now we'll look at our next example. Now let's imagine that we had the 80-20. So here, same starting point, the 100,000. we had the 80-20, but now we're saying, what if the child was over here on the 20 side when on the separate returns? What would be the difference there? So let's put that into our software. We'd say then the one that's making 80,000, then we're going to say is going to be single, not head of household, because there's no dependents. So now, and again, we're just using the same name. So one spouse now on 2 returns is at 80,000 of income, 12,000 rather than the 18 of head of household for the standard deduction. Tax is the 68,000 then. So the tax is 10,905. No child tax credit because they don't have the dependent. So here is our summary. We've got the 80,000, and then we've got the tax 10,905, and then the other side we're going to say 20,000 of income, and then the child tax would be 2,000 if applicable, if you can get the whole 2,000 given the income level. So now for the second individual, we'll have the 20,000 of income, head of household status because there is the dependent, so likely to be head of household. Again, we're just using the same return here. If we go down, we got the 20,000. Now we've got the 18,000, which is the head of household standard deduction, bringing us down to the tax then of only the taxable income of 2,000, the tax of 201. So the tax of 201 means that we can only take 201 of the child tax credit, and then we have the additional credit down here. So note that the actual credit then is really limited to 201 plus 1400 or 1601 instead of 2,000. So we don't get the full credit because of the income limitation. We get 1601. Also note that our focus isn't here on the earned income credit. We're focusing in on the child taxed credit, but this is calculated, again, it's just calculated by the software. We'll talk more about it later, but note that it's calculating right now at the 3243, and the child is something that's going to affect that as well. So that's something we have to take into consideration when we're thinking about the total taxes. So it kind of distorts the picture a little bit in terms of what would be the best total tax outcome for the child to be on one return versus another. So that's the 3243. And that means that we're not only not paying tax, but we're getting money back. So we're paying 0 tax and getting money of 4643. So 4643 money back. So if you look at that breakout, then we've got the 100,000 at the 80-20. Now we've got the child on this side, and it's limited to the child tax credit. That's where we are focusing. We actually don't get as much as the credit there. But we do get the head of household status here. Not only that, because you would think that would benefit more the higher income, but not only that, but you also get possibly an earned income credit, which really kind of distorts the picture in terms of which way would be the better way to go. So now, in this situation, there would be tax owed, 10,905 on this side, just from what we've put in the software's calculations. And on this side, there would actually be no tax paid and money coming back of 4643. And the difference between those two would be basically a total tax of 6262. So that's going to be the 480 in terms of the difference between those two. So you can consider then the total here versus basically the total here, and very different breakouts between these two items, both owing money here, and these two items where there's a huge, basically, refund and owing more on this side. So these are just a couple. There's a ton of different, of course, scenarios that could be around here. These are just a couple of them.